Stocks have been benefiting from this whole view that rates are going lower.
As much as the data becomes more and more muddy, there's a risk that continues or even exacerbates over the coming months.
While we're not expecting a significant slowdown now, we do think you're coming into a third quarter low.
We do think that the economy is much stronger than people expect.
The upside opportunity here is tremendous.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Your trading day starts right now, live from New York City this morning. Good morning for our audience worldwide. Your equity market, the losses continue. We're down 1/3% on the S&P 500. A bit of risk aversion gripping this market in the last 24 hours. Some mixed data in America and some escalation in the Middle East. The biggest one-day loss on the S&P 500 in around about a month. On the Russell, Lisa, we're down again by 0.75%.
It's a two-pronged issue. On one hand, you've got geopolitics really raising the specter of some sort of broader disruption and potentially a pop in oil prices that could challenge some of the soft landing nirvana. But we also got some employment data yesterday that I thought was really interesting. The JOLTS data, the headline was good. You look beneath the hood, the quits rate was the lowest going back to 2020. The hires rate, similar. When you got the ISM manufacturing, a similar type of trend when you look at the employment figures. So on the margins, just a little bit more of that weakening momentum.
Let's go with job openings. This was from Andrew Honhorst. Actions speak louder than openings. Hires, quits and layoffs tell a clearer story of businesses still trying to reduce labour costs by pulling back on hiring. Andrew, by the way, as you might have heard, is looking for 70,000 on payrolls Friday.
So this, to me, really goes to the heart of the uncertainty around the data. Some people saying, well, every business wants to post as many job openings as they possibly can, basically flood the zone, see how many people they get. And it doesn't actually represent how much demand there is. But if you look at people's moves, their feet mean more than what kind of openings are posted. That said, to me, the real question is, are people overly pessimistic about an economy that still is growing if you look at the Atlanta Fed GDP at a pretty fast rate? And is this market more prepared for a downturn than it is for actually a no landing or an upside surprise to economic data?
I'm still struggling to adjust to all of this. I'm sure you are at home. Bramo on the edge of bullish over the last few days.
Hold on. No. I'm saying
almost there, on the brink, on the precipice.
Don't malign me. Don't put me in that box, John. Look, to me, there's a question of just how this market is positioned. I'm less interested in calling the longer term and just saying it seems like people are prepared for the Fed to cut aggressively in the face of ongoing weakening. Whether that happens, I think if that doesn't happen, there could be a disruption.
The biggest difference right now between, I think, bulls and bears are layoffs. Layoffs right now are still really subdued. Neil Dutta, Renmac, waiting for layoffs to turn means the Fed is willingly falling behind the curve. Layoffs are still low. Will it remain that way? Let's turn to another theme. Crude right now, 2-day winning streak. Crude's waking up to what's happening in the Middle East. Crude is rallying once again this morning. Brent up by 2%. WTI up by almost 3%.
And Jake Sullivan yesterday, the president's national security advisor, said the term fog of war was invented for moments like this. And that is what the market really was able to touch yesterday. You saw this immediate increase in oil prices, 5%, knee-jerk reaction, absolute recalibration, what we saw from Iran to Israel. Now they're holding on to those gains, but there feels like there's a cap on these oil prices because of the spare capacity that's in the market, whether or not you look to Saudi Arabia or UAE. The spare capacity is there, and China's not picking up that demand that we used to see.
Brent crude at 75.50. We're up by about 2.6%. The cross-asset price action looks like this right now on the S&P 500. Equity futures down by 1/3%. In the bond market, yields higher by about 3 basis points. The 10-year 376.19. Coming up this hour, we'll catch up with Jim Bianco of Bianco Research in the no-landing camp. Norman Roule of CSIS as Israel vows to retaliate against Iran. And Rob Casey of Signum Global Advisors following last night's showdown between Vance and Waltz. We begin this hour with the recent rally firmly on hold as the world awaits Israel's next move. Investors keeping one eye on US labour market data ahead of payrolls on Friday. Jim Bianco of Bianco Research writing, I'm still a no-lander, meaning I see the economy as okay, not even showing signs of a soft landing. I can debate whether we are seeing much cooling in this labour market. Jim joins us now for more. Jim, good morning and welcome to New York.
Thanks for having me.
Lisa went through the job openings. You look at what's happening with the quits rate. Quits rate's down. Look at what's happening with the hirings rate. Hirings rate's down. Why do you not see that as a sign of a slowdown in this labour market?
If you look at the bigger picture of the numbers, they are down from, say, July or June. But the bigger picture over the last several years, these are still numbers that are very constructive for the labor market right now. If you want to expand out from the JOLTS report to payrolls to the household survey, those numbers look pretty good. Now, the one number that is weak has been the rising unemployment rate. But the Fed likes to use the phrase increase in labor supply, which is a euphemism for migration. We're getting more people coming into the country. The population growth rate in the country right now, according to the CBO, is pushing a 30-year high because of migration. And a lot of those people coming into the country are unemployed. And that's what's getting picked up in the unemployment rate, which is why that number is rising. That's not necessarily a sign that people are losing jobs.
2-year at 360 doesn't scream no landing. 10-year at 376 doesn't scream no landing. What's your view on this bond market?
You know, I think that at 360 on the 2-year note, it is priced in pretty much the Fed cutting rates all the way to say 3 to 3.25. That's in. 2-year note shouldn't go anywhere else. Wall Street is really on this idea that we're going to see a curve steepening. I guess I am too. But at this point, that's a bearish trade because we're going to stay at 360. And the way you steepen the curve is the 10-year yield has to start to rise from here. I don't see the 2-year note going, say, under 3% unless you make the case the economy's really falling apart and the Fed is going to cut rates well beyond, say, 3%, down to around 2% or lower.
I love when people say I'm a no-lander, I'm a soft lander. It's sort of like saying I'm a flat earther, but there's sort of a question here about what that means. I mean, going forward, does that mean that there just is no recession, or does that mean that there actually is a reacceleration from here of growth and inflation?
You know, you brought up a really good point because I've criticized the soft landing camp that it's this thing without a definition. So in a year, I'll define it and tell you I was correct. I think a no.
Do the same now.
Yeah. Well, I think a no-lander scenario is if you accept that potential GDP, what would the economy grow without it being stimulated or restrained is around 2.5%, 2 to 2.5%. I think that's the no-landing camp, is that we continue to grow at the 2 to 2.5% camp. Also, if you wanted to throw inflation in there, I am in the sticky inflation camp that the long-run inflation rate is probably closer to a 3 handle, if not a 3 handle, then down at 2.0%. Where the Fed thinks it's going to be. So if you add in the two together with nominal GDP, 2.5% real growth, 3-ish% inflation, you're talking about 5.5% nominal GDP. And that's where, the no landing idea comes.
How much does being a no-lander sort of hinge on this idea that authorities are ready, willing, and able to come in and step in, whether it's rate cuts, whether it's the bazooka we just got from China, or whether it's potential fiscal stimulus in the United States, despite the deficit that people care about but aren't necessarily pricing in?
Oh, I think that, the no-lander camp, if I defined it the way I do, it's all of those things give me worried that we don't need the Fed to aggressively cut rates. We don't need massive fiscal stimulus. And if we're going to get it, what we're going to do is we're going to produce more inflation, probably second half of 25. And that's really the biggest concern right now is, are we going to overstimulate? Because in the no landing camp, we don't really need that kind of stimulation, but so it looks like we're going to get it anyway.
You said you're going to take the over of the Friday's payroll report of 150K. Do you just immediately have to then slash 60, 70,000 off of that because of the revisions we continuously see? Yeah,
that's usually what happens. I think 25 of the last 31 months, the payroll report beats Wall Street's estimate. And then the revisions come in. And it's almost to the point now where people have been more and more asking me, what's your guess on revisions as opposed to what's your guess on the payroll report? Revisions, I think, are getting overstated a little bit, that usually when they run in cycles, the revisions. Up until 22, the revisions were mostly upward. And since 22, they've been mostly downward. And so I don't see the revisions as being some kind of dark secret thing that tells us that the economy's in trouble. But yeah, I probably see that the revisions will pull back on the numbers that we saw in July and August. But the headline number, like I said, most of the time it seems to be.
When we get the next payroll report, the following one, when you look at what happened in October, we're going to have Hurricane Helene's impact and also the strike workers at the ports. How difficult is it going to be to really extrapolate the labor data? Oh, yeah. And don't forget the Boeing strike, too. And so I heard Mike McKee say this the other day, and there is a possibility of a negative payroll report coming up. The payroll survey week is the 13th. If these strikes keep going into disruptions into the 13th, and we find that, getting things back to normal after Hurricane Helene goes more than 2 weeks, we could see this start to impact jobs. Remember the way the jobs survey works.
They have a company report. If the company doesn't have power or it's closed and it doesn't report, they put them down for 0 this month. They'll pick it up next month, revise it, and you could see a big dive in the numbers. Hurricane Harvey, we saw that last 2017 in September. We saw a negative payroll report off of that when it hit Houston.
Anna Wong of Bloomberg Economics. Later this hour, Anna's put some numbers on this. If the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls due the 1st of November by as many as 80,000 jobs. They think that's going to lead the Federal Reserve to cut interest rates again by 50 basis points. If those numbers actually materialise, where are you on the Fed's move, November 7th?
You know, that's going to be a difficult one, because if we were to see that type of number, and that's just off of the port strike, we still got the Boeing strike, we've still got the hurricane, and maybe disruption from the Middle East coming as well with energy prices. It's going to muddy the water for the Fed. It's going to make it very, very difficult to try and discern what is the economy doing. Yeah, we know that there's this port strike. Yeah, we know it depressed jobs. But we also know it's temporary, that the port strike will eventually end and things will eventually return back to normal. It's going to be very difficult for them. I think Powell set up the case for 25 at a couple of days ago when he spoke, in that seems to be more of the prudent action, especially that it's 2 days after the election, and there's a reasonable chance we won't know the outcome of the election by November 7th as well.
Jim, it's good to see you here in New York too. Thank you, sir. Jim Bianco there of Bianco Research. Just touching on the Middle East there. More on that in just a moment. Brent crude this morning up by 2.8%, 75.61. With an update on stories elsewhere this morning, let's get your Bloomberg brief and cross over to Danny Berger. Hey, Danny.
Hey, John. Less than a month after its big Glow Time event, Apple is already preparing for its next product launch. People familiar tell us that they are preparing to announce a new low-end phone early next year that will also be alongside upgraded iPads. The new iPhone SE, it is codenamed V59. It will become the new entry-level model. The release will mark the first update to the SE since 2022, when Apple added 5G capabilities to the device. Bloomberg reporting that KKR is considering a takeover bid for chipmaker ASMPT. People familiar tell us that KKR has made a non-binding prelim approach, and it will take the Hong Kong-listed firm private. Considerations are at an early stage. They might not lead to a transaction, but may attract interest from other buyout firms. ASMPT posted its biggest intraday gain in more than a year on that news. And Lisa spoke to Bridgewater's Karen Caranold-Tambor at the Bloomberg Volatility Forum.
The economy is basically fine. There are some worries about it, might be a little above, a little below, but the Fed is willing and able to make sure it doesn't get worse than that. And that combination is usually a great backdrop if you're just sort of saying, is it going to be a good time to take risk? That's a good time to take risk.
She went on to add that bonds are back to being good growth protection, and they are serving their role in a 60-40 portfolio. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. We got to the bottom of the mystery. Bit of Bridgewater rubbing off on Bramo yesterday afternoon.
Hold on a second. Wait a second. Pause. Every single person who I talked to said at the volatility conference, everyone was looking for downside protection. No one was looking for upside protection. Everyone was looking for ways to put on the steepener trade. No one was talking about a flattening trade. Nobody was talking about the potential for a strong dollar. Everyone was short. When you start looking at those crowded positions on a tactical basis, I understand the argument from a contrarian perspective of how the other side might be a little bit more disruptive. So now you're just
contrarian, just to be very clear.
Yeah, I mean, it's just basically which side of the boat. If everyone's on this side, I want to go on the other side.
Lisa's on the other side of the boat. You will know now. In line with Max Kettner over at HSBC. Up next on the programme, Iran attacks Israel.
At my direction, the United States military actively supported the defense of Israel, and we're still assessing the impact. But based on what we know now, the attack appears to have been defeated and ineffective.
The latest news out of the region up next, live from New York City this morning. Good morning. The slide continues. We're down another 0.4% on the S&P 500, and the rally in crude picks up as well, up by more than 3 on WTI, $72 a barrel. Under surveillance this morning, Iran attacks Israel.
At my direction, the United States military actively supported the defense of Israel, and we're still assessing the impact. But based on what we know now, the attack appears to have been defeated and ineffective. And this is testament to Israeli military capability and U.S. military. Also a testament to intensive planning between the United States and Israel to anticipate and defend against the brazen attack we expected.
So here's the latest. Israel promising retaliation after Iran fired nearly 200 missiles at the country. Israel saying most of the missiles were intercepted with the help of U.S. forces. The attacks killing one person in the West Bank. Bloomberg's Jemana Besechi, helping us lead the coverage out of the region, joins us now. Jemana, what is the latest this morning?
Yeah, I mean, just another round of escalation in the Middle East. At 7:30 p.m. local time yesterday, nearly 200 of those ballistic missiles were fired from Iran into Israel, triggering Israel's air defense system. Now, IDF said pretty much all of those missiles were intercepted, caused limited damage in the end. One person did lose their life, but that was on back of exploding shrapnel. With Iran State TV actually saying that the strikes had targeted important security and military sites. So that's what was being presented back home. Now, of course, from Iran's perspective, they had been warning for several weeks now that a retaliation was forthcoming, not only after the assassination of Ismail Haniyeh in Tehran, but more recently after the killing of Hassan Nasrallah in those airstrikes in Beirut. And alongside that airstrike that took out Hassan Nasrallah, by the way, you also saw the killing of a senior IRGC commander. So they've taken multiple blows to key figureheads within this axis of resistance and had to show that they were going to be doing something. And of course, that response did come in the last 24 hours. Now, it does mark an escalation versus the first time Iran launched a direct attack at Israel, and that was back in April. This time around, the missiles that they used were ballistic missiles. They're more precision guided. They're more long range, a bit more high tech than the sort of slower moving drones that they moved back in April. And also, crucially, there was less of a heads up this time around versus the incident back in April. Now, we just heard, you played some comments from the Israeli Prime Minister, Benjamin Netanyahu, who said Iran made a big mistake tonight and it will pay for it. So today, the question is, what form of reprisal is going to come from Israel? Many within the Israeli cabinet are pushing for a more hawkish response, but the response could come in multiple forms. It could be strikes at particularly military assets, like what happened back in April, but it could take the form of further assassinations, even potentially striking energy infrastructure. And if they want to go one step further, this would be obviously a severe escalation, strike nuclear sites as well.
The escalation continues. Jemana, thank you. Jemana Besechi there. Joining us out of Dubai this morning, Norman Roule joins us now, the former senior US intelligence official. Norman, as we know, over the past few weeks, discussing these events together, Israel has demonstrated superior defense, superior intelligence. They've done so repeatedly. A question I heard Peter Cheer ask over at Academy Securities, why would they stop now? Norman, why would they stop now?
Well, good morning. It's a limited capability. The shark closest to the boat. Or a variety of different issues. They're fighting an insurgency in Gaza. They've begun a long-term, what could be a long-term conflict in Lebanon. Operations against Iran would require a tremendous amount of intelligence, a very heavy strain on the logistics of the military, and would also require extremely close and coordination with the United States. That is a United States that is unwilling to ignite a new conflict in the Middle East. So I don't think it's a question of stopping so much as a question of coming up with a Goldilocks style attack. You want something that deters Iran, demonstrates to Iran Israel's capability, sends a message to the regime, but does not ignite that conflict that would require such significant U.S. support.
Norman, we heard from Secretary Austin yesterday on Twitter. He put out a statement following his conversation with his Israeli counterpart before the attack. And he said, we discussed the severe consequences for Iran in the event Iran chooses to launch a direct military attack against Israel. Well, Iran did, and it was twice the size they did in April. What is the list? What is the menu of consequences this administration is willing to take on Tehran?
That is unclear and likely something that is the subject of some debate within the administration. Secretary Austin's comments were also reflected in the statement by the National Security Advisor, Jake Sullivan, who also used the phrase severe consequences. But for Washington, an administration at the end of its tenure, an election underway, a process of unwillingness to involve itself in external conflicts, the idea of starting a war in the Middle East is going to be at the bottom of their list. The question becomes what can be done beyond symbolic sanctions. And this is important because we saw things happen yesterday, but we didn't see two things. First, we didn't see Iran's other proxies pile in with the Iranian attack, which will tell Israel's generals this is an opportunity to perhaps spend more time in Iran. But also importantly, the U.S. military presence in the region, which included a powerful offensive capability, did not deter Iran. Now, Iran changed its tactics. It did something very different from April to get around that presence, but the offensive potential of that presence did not appear to play a role in Iran's decision-making. And the administration will have some difficulty changing that absent a military strike. One comment on Israel's possibilities. There are cyber options. There are a variety of options that could be undertaken. But Israel is unlikely to strike energy areas that are going to touch the global economy. There are parts of Iran's energy structure that only impact Iran. There are parts of Iran's military that only touches their external power projection. So there are a variety of different targets in Iran that Israel could touch that would not impact the global economy.
Norman, I'm looking at a map right now of the U.S. military presence as of the start of this month, October 2024. Bases that they've operated in the last 15 years, but also naval deployments. What does our current force posture say about potentially what more we can expect from Iran?
Well, we have about 30,000 personnel distributed throughout the Middle East, and all of those personnel, their bases, would be potential targets for the Iranian retaliation for any U.S. involvement. So U.S. policymakers should consider what would happen to those bases and what it would mean for the countries that host those bases if the U.S. did participate in an attack on Iran. The naval presence is extraordinarily robust and also includes some of the most advanced aircraft in the history of the planet. Our F-35Cs, F-22s, F-18s, F-16s, A-10s. We've rarely sent such an array of air power to any spot in the world as we've got now sitting in the Middle East.
Norm, how much more power does Israel have at this point versus Iran because Hezbollah has been dampened? Or is that a fiction? Is that basically the theory that is driving some of the potential attacks that you don't see as really accurate?
Well, Israel has a significant amount of power that has not been used. It has a missile component of its own. Its air force is very, very impressive and very capable. But again, they've got the Lebanese conflict underway. They've sent additional ground forces into southern Lebanon to root out Hezbollah bases. They're undertaking attacks with their air force on weapons caches and command and control sites throughout northern Lebanon. They've got other duties besides Iran. And when you're thinking about an attack on Iran, that's a distance issue. And it's not just one strike. You're not just dashing east and dashing back. If you need repeated strikes, that involves refueling capability. You have complications with airspace over Iraq and Jordan. This is a serious operation to be undertaken. Israel can do things, but it would require a lot of planning. And again, coordination with the United States would be paramount.
We always appreciate your insights, sir. Valuable. Thank you. Norman Roule there, former senior U.S. intelligence official. One thing I can tell you regarding the market, crude, one of its worst months of the year so far in September. October waking up big time. Two-day rally, WTI up 3% this morning. Because of the prospect of what Annmarie mentioned, that potentially Saudi Arabia's oil assets could be targeted. That said, and I think that it was really good to hear from Norm there, how much is Israel really willing to do that if it ends up creating a difficult situation for some of the allies? How insulated is this commodity market with oversupply? On the same day we saw those attacks yesterday, HSBC cut their outlook for crude. We'll come back to that in a moment. Equity futures right now negative 1/3%. Up next, Rob Casey of Signum Global Advisors on the key takeaways from last night's debate. equities trading just a little bit softer to kick off Q4. We're down again by 0.25% on the S&P 500. Negative yesterday, biggest one-day loss in the last month or so. On the Nasdaq 100, we're down 0.25%. Some of the pain really concentrated in the small caps. The Russell, Lisa, down 0.75%.
On the heels of what we saw out of yesterday's JOLTS report and ISM, not the headline numbers. That was actually better than expected on both fronts, albeit still in contraction for manufacturing. It was in the employment component. The fact that quits rate had fallen to the lowest going back to 2020. Think about it this way. If you're in a job and you feel confident enough to voluntarily leave said job to go to another job or pursue some sort of hobby in your life, then the job market is doing pretty well. And if you don't, that is what's raising red flags for a lot of people.
A lack of confidence right now, and you see it in the hiring rate. You take out the pandemic, we're talking about a level we haven't seen going all the way back to 2013. What we're not seeing, layoffs. That's where the big debate is right now in the labour market on Wall Street. That's the equity picture. Here's the bond market story. Turn the page. 2-year, 10-year, 30-year. The 2-year right now, 362. The 10-year, 376. Yields up just a little bit. But yesterday was this classic risk-off, risk-aversion story.
That actually might be the most interesting aspect of yesterday. The fact that it was risk-off because of the jobs data came out. And then you had what happened in the Middle East, and that continued and turbocharged some of the flight to a haven asset. The fact that bonds were considered a haven in the same way that they had been in the past was notable to a lot of people in a time when that wasn't the case not so long ago, maybe a month or 2 months ago. So that's actually something to watch. How much are bonds still the equilibrium, the flight to haven trade in some sort of crisis?
This all happened in a 1-hour space of time yesterday morning. The data dropped in America. At the same time, we got some reports we're about to see escalation in the Middle East. And crude woke up after being asleep for the whole of September. The worst month of the year so far for WTI. We leave that behind and we rally up another 3% on Brent, up by more than 3% on WTI. I mentioned HSBC. On the same day we saw that escalation, HSBC cutting its 2025 Brent crude forecast by 8% to $70 on oversupply. This market has been very, very focused on that one issue, oversupply.
That's because that has been the issue that has driven pricing. If you bet on geopolitics and potential disruption, you failed, because that's not the direction that things went in. And I think that people are just recognizing, look, you've got the U.S. producing more barrels of oil than any other country in history with respect to the shale patch. You have a situation where China's demanding less because of the EV transition, and you're seeing that more broadly. Where is that impetus going to come from to fulfill all the supply, let alone questions around demand in a cooling, potentially, economy?
It's both supply and demand that's keeping a lid on these oil prices. The fact that supply is not being hit when it comes to this escalation. But to your point on China, Goldman Sachs yesterday also putting out a note. Our demand slipped further below our expectations. And that basically means you can have a recalibration of risk premium in the market, but there's going to be a ceiling.
Crude. 72.14. Under surveillance this morning, the dock workers' strike entering its second day with no end in sight. Container operations and auto shipments remaining halted along the eastern Gulf Coast. House Republicans sending President Biden a letter urging him to intervene.
They want him to intervene, and basically what they want him to do is come out and either upset rank-and-file union workers or potentially not come out, what they'll tell you behind scenes, and this becomes an issue for the economy. I spoke to Congresswoman Elise Stefanik yesterday in the spin room at the VP debate, and she wouldn't say, though, whether or not the president should invoke the authority he has to get union workers back for 80 days, but said it's a crisis of their own making. So certainly politics are going to play when it comes to this story ahead of a very important election.
Well, Donald Trump was even quoted saying that he doesn't want automation, and he wants the workers to actually be able to get what they want, with the promise that there isn't going to be some sort of modernization at the port system. A real question here, and I'd be curious to dig a little bit deeper into just how much he is opposed to that. You hear the same kind of tone in terms of you need to get people together, but you need the workers to have power. At the same time, I was looking at what they're looking for. 50% wage increase over 6 years, which is a boost from an earlier 40%. And that would raise the base hourly wage from $69 to $69 from $39. Do you know that more than half of the dock workers earn more than $150,000 a year? So it's talking about what's required to get people in the door to actually do these jobs.
They've got a lot of leverage right now, and they're going to use it. That's for sure. Let's keep the news right here in America. The U.S. Southeast facing a humanitarian, economic and ecological crisis in the aftermath of Hurricane Helene. The death toll rising to more than 150 across 6 states. The Vice President, Kamala Harris, speaking in Georgia this afternoon on federal emergency response efforts. Look out for that. Elsewhere in the world of politics, Vice Presidential nominees J.D. Vance and Tim Walz facing off last night, the two taking aim at each other's running mates and clashing over key topics.
One thing that Joe Biden did is he continued some of the Trump tariffs that protected American manufacturing jobs. It's the one issue where Kamala Harris has run away from Joe Biden's record.
Well, Kamala Harris's day one was Donald Trump's failure on COVID that led to the collapse of our economy.
If Kamala Harris has such great plans for how to address middle-class problems, then she ought to do them now.
How is it fair that you're paying your taxes every year and Donald Trump hasn't paid any federal tax in the last 15 years?
Iran, which launched this attack, has received over $100 billion in unfrozen assets thanks to the Kamala Harris administration.
It's those that were closest to Donald Trump that understand how dangerous he is when the world is this dangerous.
Joining us now to discuss, Bloomberg's Mike Shepard from the nation's capital in Washington, D.C. Mike, most neutral observers seem to believe that Senator Vance won that debate last night. Does it make a difference?
You know, it's a great question about what kind of impact any of these debates, even the presidential debates, have on people's minds when so many voters in this very divided nation have already made up their minds. And will it tip people one way or another? What they were really doing is trying to redirect their attacks at their running mates. And they really wanted to make sure the focus was on Donald Trump. We saw attacks from Tim Walz against Trump, declaring once again, keeping up the Harris line, that the former president is unfit for another term. And likewise, J.D. Vance trying to hang the albatross around Harris's neck of what he sees as failures on the economy, the border, and foreign policy of the past year. So in his view, why does she deserve another 4 years as president if it hasn't been so great in the Republican view as with her as vice president? So in a way, they are reinforcing the message and also trying not to make too many mistakes. For Vance, it was also a moment where he could sand down some of the edges that we have seen surface in some of his social media and also public appearances on TV, where we've seen a little bit of a harder edge that has weighed on his favorability. Meanwhile, for Tim Walz, this was more of an introduction nationally to the public. And he was a little bit nervous and halting at times. And it's a sign that he may need to get out there a little bit more and do some more interviews.
Mike Shepard down in Washington. Mike, appreciate it. I think a lot of people felt that way, that you could see that Governor Walz hadn't been getting reps at the weekend shows, that he'd been hidden for so long over the last few weeks that he wasn't used to having that kind of debate with Senator Vance.
He definitely came across as very nervous, especially in the beginning. His best performance of the debate was at the very end. And also, I think he was nervous because how much you saw basically just his forehead, because he was constantly writing down on these two shots instead of what J.D. Vance did was really look at him and have that presence.
Rob Casey's with us now of Signum Global Advisors. This is what Republicans had been waiting for. They'd been waiting for someone to prosecute the case, to tie the vice president to this current administration. Did Senator Vance do a good enough job?
Yeah, I think he did. I think since the Republican National Convention, we've all been looking at each other saying, you know, why is J.D. Vance on the ticket? He hasn't done very well. I mean, he's okay in interviews, but he's not great talking to voters. He's not great in those more informal interactions. He's really good on the debate stage, right? He's an Ivy League lawyer. He was in private equity venture capital. Now he's a politician. I mean, he's a pretty smooth guy.
Frank Luntz, who's a well-known pollster, definitely leans Republican, but well-known pollster, he had a focus group where only 5 individuals were leaning towards Trump-Vance going into it. After the debate, it ended up 12-2 in J.D. Vance's favor. Could this move any voters in the swing states?
You know, I don't think so. Maybe a presidential debate moves a few undecided voters. I think a vice presidential debate, not so much. Now, what we've seen in history is even some of the worst vice presidential candidates, I mean, thinking about Sarah Palin in particular, actually wasn't much of a drag on the ticket. Now, J.D. Vance is actually less popular, more unpopular than Sarah Palin was. He took a step, I think, last night, improving his standing. He's more popular now than he was yesterday morning, but I don't think he's convincing anybody to vote for Donald Trump just because, 90 minutes he was able to hold his own.
What do you think was the most impactful moment both sides were able to deliver? And then, of course, they're going to, spread this out on all their social media channels.
Yeah, well, I think for Democrats, what they're going to share most frequently, most often over the next few days, is the fact that J.D. Vance was not willing to say Donald Trump lost the 2020 election. I was surprised by that. I thought he probably would have had a better answer to that question. And, for Republicans, I think they're going to want to share just about the whole debate, right? J.D. Vance made the case time and time again. He looked much more prepared than Tim Walz. He looked much more at ease on the debate stage. And he was really able, much more effectively than Trump did in the first presidential debate, to tie Kamala Harris to the economy and the border over and over and over, regardless of what the question was about. The answer was about Kamala Harris, the border, the economy, and how she has been vice president for 3.5 years and hasn't enacted what she's now promising.
We didn't hear about people eating pets. We didn't hear some of the other accusations. This, according to Punchbowl, it was like watching a sepia-toned debate out of the 1990s. Lots of talk of policy and legislative politics. Yes, let's dig in. Do you feel like you got a better understanding of what the policies were and sort of the overtones of how they would be implemented for each of the candidates based on this debate?
Well, I think Mike Shepard was right in saying that neither candidate wanted to make many mistakes. So they weren't willing to really nail down into the nuances of the policy that the presidential candidates are offering. But, I'm not surprised that Punchbowl is happy to talk about legislation, right? This was a policy debate. It felt like a little bit more of a throwback. And I have to say, it may be that the most important contrast that came out of last night was how nice is it to have a debate where Donald Trump isn't on the stage, right? It wasn't necessarily between Vance and Walz, although I think fair to say Vance won last night's debate. It's really nice to be on the couch for 90 minutes, listening to politicians talk policy, cordially, sometimes competitively, but it was nice to not be listening to Donald Trump.
Do you think that Donald Trump liked this debate? Because that's been sort of a big question with J.D. Vance and how much he's catering to the running mate or how much he's actually presenting his own views.
Yeah, I think he did like the debate. Now, I did see some commentary on Twitter last night that sort of suggested that J.D. Vance wasn't doing enough to defend Donald Trump, per Donald Trump, or at least people thinking about how Donald Trump might view the debate. The thing was, we've all been sort of critical of Donald Trump's decision to pick Vance in the first place. I think last night was the case for why J.D. Vance is the right running mate for Donald Trump, right? He's unpopular. He's increasingly unpopular throughout the campaign. He's had a pretty bad rollout, but he's a great messenger and spokesman for sort of Trumpism generally. And I think he's a pretty obvious, inheritor of that brand when Trump either wins and then steps aside or steps aside in January.
Just quickly, 1 month left. Was that the last debate?
Yeah, I think so.
Yeah?
Yeah,
Okay.
I don't think either side wants to get back on the debate stage. It's weird that the final, public national word is going to come from the vice presidential candidates. But I think Harris is happy with her first performance, and I think Trump is, he'd rather be tweeting and truthing than be on a debate stage.
Rob Casey of Signum Global Advisors. Rob, appreciate it. Thank you, sir. Check out this move in the FX market. Dollar yen popping higher, 144.56. Comments from the Japanese Prime Minister just moments ago. Not the environment to raise interest rates again. Not in the environment now to raise interest rates again. Bear in mind that when Ashiba came on board, we were talking about a man who was supporting the normalization process over at the BOJ. Those comments counter that view in a big way.
And we heard something similar from Ueda talking about, we need to take our time and be much more supple with our policy. You heard that earlier today. He said he wants to coordinate, Ishiba, the prime minister, wants to coordinate with the Bank of Japan on the economy, and they want to make the economy strong with an economic package, avoiding deflation and the spiral that Japan was in, key on their minds. It just raises this question, especially because this move isn't as big as I actually would think. It makes me wonder how much we've sort of worked through some of the levered short yen positions that could get blown out. And this is just basically the market trying to calibrate how much to make of this.
Dollar yen, 144.60. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Mexico has sworn in its new leader, Claudia Sheinbaum, the country's first female president. In her inaugural address, Sheinbaum pledged to continue the efforts of her mentor, AMLO, and improve the lives of the country's poorest people. The former Mexico City mayor also spoke to the business sector, promising that private foreign and domestic investments in Mexico will be safe during her government. BMW is urging Germany to vote against higher EU tariffs on Chinese-made EVs. That does echo similar language from other German car makers who just don't want to risk a trade war with the most important market. BMW CEO Oliver Zipse warns that the additional tariffs will harm global companies and, quote, could provoke a trade dispute from which no one gains. On Friday, EU member states will vote on imposing definitive tariffs as high as 45% on imported EVs made in China. Pink Floyd has agreed to sell the rights to their music. The FT reporting that the rock band will sell their music catalog to Sony for about $400 million. They cited two people familiar with that matter. The deal includes Pink Floyd's recorded music, the band name, and the artist's likeness. The deal, however, does not include the band's songwriting rights. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, half of U.S. trade at a standstill.
First few days, the economy can handle, we think. There should be stocks of inventories that are there at the dock, that are there in retailers' inventories. The bigger issue is, do you have inputs to the production process that you really can't substitute for?
We'll put some numbers on all of this up next on the program. Live from New York, you're watching Bloomberg TV. Looking at potentially 2 days of losses here on the S&P 500, down by 0.2%. Bond yields a little bit higher, up by 3%. The standout move, crude once again, up by 3.5%. WTI, 72.26. Under surveillance this morning, half of U.S. trade at a standstill.
First few days, the economy can handle, we think. There should be stocks of inventories that are there at the dock, that are there in retailers' inventories. The bigger issue is, do you have inputs to the production process that you really can't substitute for? It could be a month from now where you can't produce the new cars. And then that's where retailers will have to start to say, we actually have to raise these prices. We have a shortage of goods.
So here's the latest. The strike at all major ports on the U.S. East and Gulf Coast triggering fresh concerns about job losses and supply-driven inflation. Anna Wong of Bloomberg Economics writing, if the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as many as 80,000 jobs, which would boost the odds of a jumbo rate cut at the November FOMC meeting. Anna joins us now for more. Anna, I enjoyed the note published yesterday afternoon. I want to say thank you on behalf of the team because it was a fantastic read. There's a word that jumped out for me, inventories. How well stocked are we now versus where we were several years ago?
Yeah, so when we looked at wholesale inventories, we can see that cars, for example, which is one of the most affected category by the strikes, has a higher inventory level to sales ratio than most times in the past 20 years, except for 2020 and 2009. So we're not in a situation right now where you have a supply shock in combination with strong demand. Demand is not really there. So we think that the inflationary effect of the strike would be more muted than what we had seen in 2021 and 2022. Anna, your jobs call hinges on this lasting more than 2 weeks. What's important about 2 weeks? Just a quirk of the calendar? What is it? It's a quirk about how payrolls are measured. So in order for a person to be not counted in the payrolls, you need to not receive a check in the entirety of the reference week. And the reference week from the payroll goes from October 1st to the day involving the 12th. So basically, you need the strike to last for at least 2 weeks because most people are on a 2 weeks payroll. And then all 45,000 people who are on strike will not receive a check in the first 2 weeks. Then you will start to see these numbers showing up. And on top of that, beyond 2 weeks, you'll have the supply chain effects. So basically, the truck drivers won't get paid. And we also see a lot of impact on food and beverages, people catering to the longshoremen, and also a lot of employment services. Retail, wholesale people will start to be affected, and that's how we got the 80,000.
Anna, appreciate the update. Anna Wong of Bloomberg Economics. Anna's quote, if the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as much as 80,000 jobs, going on to say that would boost the odds of a jumbo rate cut at the November Fed meeting. Ryan Sweet of Oxford Economics joins us now for more. Ryan, I'm sure you followed a bit of that conversation. Why wouldn't the Fed just look through all of this and assume that those jobs come back, things bounce back in the months ahead?
Well, I think most likely they would. I mean, the Fed's laser focused on the labor market. And as Anna pointed out, the port strike isn't the only noise that we're most likely going to get in the October jobs number. We have a Boeing strike. We have Hurricane Helene. So the October employment data is going to look very, very messy. And odds are the Fed kind of downplays that and tries to separate the signal from the noise. and it's just going to be too noisy for the Fed to make any concrete assessment of the labor market based on just a single report.
Ryan, one thing that people have been talking about is that the effects of this kind of strike aren't that significant in the first week, maybe even the first 2 weeks, but the longer it goes on, it has an exponentially higher impact on GDP and on just jobs in general. What is that trigger point? What is that sort of time frame that you start to see the ramifications becoming exponentially more significant?
Yeah, I'll start to get really worried if this drags into week 3, week 4, because even though we do have a boatload of inventories, retailers did some preemptive inventory build ahead of the port strike. A lot of the perishable goods that are imported through the ports in the Northeast and the Gulf Coast, they can get shipped in via truck through Latin America and Central America. But if this lasts 3-4 weeks, then the economic costs, as you pointed out, kind of escalate very, very quickly. So as of right now, each passing week shaves about 1 percentage point, a tenth of a percentage point, off of Q4 GDP. But if this drags on, the economic costs just begin to escalate very, very quickly.
You talk about $4.5 billion to $7.5 billion of U.S. GDP being reduced for every week that this continues. You also pointed out that it would take about a month for every week to recover some of the backlog. A key question about why now? Why the leverage right now seems to be more with the workers to do this? Is it political? Is it because workers generally have more leverage in their jobs? Or is that era on the wane and this is sort of the last gasp of that?
Well, this isn't the first strike that we've seen over the last several years. And then I don't think this is the last gasp. But, I'm not sure if this is political, if this is just, timing of when the contract was, negotiations started running out. But from our perspective, just looking at the economics, the nuts and the bolts, that's key for us. And this is poor timing. This is, it's not the worst timing in the world. A few years ago, there was sorts of other strikes that would have really undermined the economy. The U.S. economy is in, pretty good shape. Trend GDP growth is 2.5%, 3%. The unemployment rate has ticked up, but we're still creating a number of jobs. The timing is never great for a strike like this, but hopefully this lasts just a week or two, and it's a little bit of another blip on the economy's radar.
Ryan, given the fact that shipments are now being redirected to the West Coast, what kind of crunch and backlog are we going to see on the West Coast?
A lot. I mean, the capacity, if you look at, for example, when the bridge collapsed near the port of Baltimore, some of that trade could get rerouted to the port of Philadelphia, up to New York. With a strike of this magnitude on the East Coast and the Gulf Coast, those shipping routes, they can't get rerouted to the West Coast, all of it, because there's just capacity constraints. So this is going to cause, a significant backlog, but we can work through this. I mean, it's going to take time. When the strike ends, it's not like we're going to be able to work through all the container backlog in a couple of days. This is going to take potentially weeks and even a month or two. But the good news is, the impact on the labor market, the impact on GDP, most likely is going to be temporary. We don't see any inflationary implications from this unless this does drag on for a month, 2 months. But we should be able to avoid any reflationary surge.
Ryan, I've got 10 seconds left on the clock. What's your jobs number for Friday?
165. But the key number to watch for is the unemployment rate. That's what the Fed's looking at, and that's most likely going to tick up to 4.3%.
Interesting. Ryan Sweet of Oxford Economics. Ryan, appreciate it. I won't ask you what next month's job number is going to be because that's going to be very messy. 150, the estimate for Friday.
And really, to me, one of the questions is how much are we looking at a market that's more poised for a downside surprise than an upside surprise? In other words, which is the more disruptive type of number, 160 or 130? Ostensibly, it's not going to make a difference if you get to 4.3% on the unemployment rate, but really that's the kind of difference that I'm looking for.
Equity futures right now in the S&P 500, slightly softer. We're down a tenth of 1%. A big morning for jobs data. The ADP report at 8:15. Tomorrow morning, jobless claims at 8:30 Eastern time. Then on to Friday. The median estimate in our survey, about 150 for payrolls Friday. In the next hour on Bloomberg Surveillance, here's the lineup for you. Wei Li of BlackRock, Javier Blas of Bloomberg Opinion, and we'll be catching up with the CEO of Apollo, Marc Rowan, at Apollo HQ. That stock yesterday closing at all-time highs on Investor Day with a very punchy target, projecting $10 billion of annual earnings in 5 years. We'll get into that and what to do with your money. That's in the next hour of Bloomberg Surveillance.
growth may not be strong enough to keep the unemployment rate from rising. So that's another reason for the Fed to be easing.
With the Fed really wanting to be patient and not overreact, I think that they'll likely go from a 25 basis point cut from here on out.
This is the stuff they're trying to figure out to get us to have that soft landing.
You're very unlikely to see a recession materializing over the next 18 months.
In terms of our own economy, I actually think it's going to be fine.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Was I too bullish? Was that what happened? I'm not Jonathan Ferro. He left to go have that interview.
Out of the studio.
Yeah, stormed out of the studio to go to Apollo to interview Marc Rowan. We will continue this morning. Looking forward to that interview in about a half an hour time from New York City. Welcome back. This is Bloomberg Surveillance. Annmarie Hordern here. I'm Lisa Abramowicz on second day of losses, really a turmoil here as people parse through a whole host of potential downside risks to the economy, not least of which is the fact that it's October and tends to be a tumultuous week. But really very much front and focus, we're looking at the Russell 2000 underperforming the most, down by 0.6% on the heels of a couple of data points yesterday that raised some questions, Annmarie, about just how resilient, just how much momentum there is underpinning the U.S. labor market.
Right, and the quits rate, which you brought up earlier, fell to the lowest level since the pandemic, which is why I think it's so interesting today. We are going to get ADP, and more people in the market are actually leaning into ADP because they just don't trust what's coming out, the data that's coming out of the Labor Department. So we also, of course, will have jobs this week. That's going to be really important. But I almost want to look through this jobs report because the next one will be so much more interesting. Boeing, the hurricane, and the dock workers. What kind of impact will that have? And will that mean a recalibration potentially at the Fed?
This is the reason why people are sort of wondering how much credence to put into these different things. Watch this space in 75 minutes. We're going to be getting that ADP report, which people are putting a greater emphasis on. We are seeing in the oil space a rally, second day of a pretty significant rally on the heels of some of what we're seeing in the Middle East. Iran launched a direct ballistic missile attack on Israel, about almost 200 missiles coming over. They were mostly shot down, but a real question about what kind of response there will be, given the fact that Israel pledges to retaliate. I just wonder at this point, Annmarie, how much people have gotten used to, benumbed, if you will, to this idea that any kind of escalation in conflict isn't going to have massive ramifications on the oil space.
That's because of two things. One, we haven't actually seen supply that's actually getting hit. And then if you're concerned about supply, we'll just look no further than Riyadh or Abu Dhabi, where they have spare capacity. Then on the demand side, China is not picking up. Goldman Sachs, HSBC, they're still talking about the fact that they're not seeing that demand from China. So that's putting a lid on the actual prices. But that 5% we saw yesterday, that knee-jerk reaction when Iran, for the second time this year, sent over ballistic missiles to Israel, 5%, the market is still carrying that through. So there's a little bit more risk premium actually baked in when it comes to geopolitical risk.
So what strikes me right now is you've got the jobs data that's coming through. We're going to get ADP at 8:15 a.m. Eastern ahead of that jobs report on Friday. We have what's going on in the Middle East, the geopolitical tensions that are percolating up. And then you have this, which is the stimulus, the bazooka. It's increasingly looking like a bazooka from China that a lot of people are saying is truly a game changer. People thought that there would be some kind of response, but this was such a market response that suddenly people are rethinking just how much they can avoid going into China. Chinese stocks listed on the Hong Kong index came in with a 7% gain after a holiday, and it really highlights just how much the tone has shifted. You just wonder how much of a knock-on this effect this will have in the broader market.
I still have a question, though, whether or not people are travelers or settlers when it comes to the Chinese market. Because, yes, this is a bazooka, this is stimulus immediately to the equity markets, but also only in China. What about all those companies that are exposed to China, like in Europe? They're not doing well because they see the national buying in China. And then secondly, long term, is this actually going to address the fundamental issues on the Chinese economy? I still can't get over the fact that in August they had one of the highest youth unemployment rates. Who is buying these products if people don't have jobs?
Well, does that matter if everyone's feeling really good right now? We're going to have that conversation coming up. Wei Li joining us of BlackRock, turning overweight on China following what some people are calling a bazooka. Bloomberg's Javier Blas' strikes on Israel send crude soaring. And our own Jonathan Ferro noted he did not storm out of here angry at us. He is sitting down with Apollo CEO Marc Rowan. We cannot wait to hear that conversation. We begin this hour with traders looking for opportunity thanks to the added stimulus out of China. Stocks surging in Hong Kong, as we were just talking about, with optimism growing for the world's second largest economy. Wei Li of BlackRock saying this: We see room to turn modestly overweight Chinese stocks in the near term, given their near-record discount to developed market shares. We stay nimble and could change our view if the stimulus details disappoint. Wei Li joins us now. Wei Li, Annmarie was just asking, and it's a good question. Are you a tourist or are you settling down in some of these Chinese assets?
For now, I would say I'm a tourist. To your point about is it a game changer? I don't know if it is a game changer, but it's creating near-term momentum. So just to contextualize our China view change, our longer-term cautious view hasn't changed, but we're looking at the very attractive valuation, which is around 50% discount, which is close to a record versus the DM equity counterpart, and extremely light positioning. You look at global active equity allocation to China, it's at close to 10-year low at this point. Of course, cheap valuation is never enough to turn around a market, but when you have valuation and catalyst, which is taking place in the form of stimulus hopes, you see this incredible momentum, which is what we're leaning into. But longer-term challenges very much stay and remain. We're talking about aging population. We're talking about the need for reform. Just for how long can you keep issue government debt, lower rates? That's a template that could work over the near term, but you do need reform to be more persistent.
Are you surprised that Europe isn't also moving higher? Some of these companies that are deeply exposed to China are not moving higher on this stimulus package?
I think that is a great observation, and I think that very much speaks to the fact that this is a near-term momentum story, because if there is huge amount of confidence that this is really going to kind of fix the Chinese economy, then the beneficiaries, secondary beneficiaries of that would actually react. But European equities are not reacting, which shows that it's right now a momentum-leaning story, which is what is underpinning our tactical upgrade.
There's a fascinating kind of implication underneath this, which is you're looking for places to take advantage of risk and momentum to the upside. And it raises this question, especially given how much sort of fear there has been in markets throughout the bulk of this year and how much concern there is about the labor market falling off a cliff. Are you just structurally in a risk-on mode, looking for those opportunities to chase, whether it's the stimulus coming out of certain governments or whether it's rate cuts, is it monetary or whether it's fiscal stimulus?
Well, I think I should always say no to, am I always structurally risk on? Because there are always issues that we should be worried about. But to your point, at this current juncture, yes, we are. And that is despite the fact that seasonality is not supportive of more risk-on posturing, right? We're talking about both this time of the year and also this point in the election cycle. So seasonalities aside, we do see overall environment still supportive of taking risk. We're talking about growth still okay in the US. Q3 GDP nowcast is tracking close to 3% on an annualized basis. You talked about labor markets. Labor market is doing fine. It's tracking at a pace that is above pre-pandemic levels. And some of the concern around rise in unemployment rate has to do with the positive supply shock through immigration, which is very different from companies laying off people. And then you have the Fed starting to cut and cutting quite quickly as well. We do disagree with market pricing that takes policy rates to below 3% by the end of next year. So we agree with they got to cut. They are cutting right now, but maybe they wouldn't cut as much as before. But the fact that they are cutting is supportive of the risk sentiment, which is what we're leaning into as well. But we're no longer as concentrated in the tech story as we were for most part of last year and this year. We broadened out to the overall U.S. equity market because we see kind of the AI story broadening out, and more broadly, when markets get too worried about recession fear, leaning against that requires a broad-based implementation strategy.
Your colleague Larry Fink was talking about how he thinks that maybe too much has been priced in when he was speaking with Francine Leclerc. Okay, well, good. I'm glad to hear that. I'll let him know. I'm sure he's watching. Larry, she agrees with you. There is a question about how offsides this market would be if we get an upside surprise to non-farm payrolls. In other words, what would be the biggest node of volatility right now? A downside surprise to the labor market or an upside surprise?
I think that has to do with if markets are focused on the the growth story or if markets are focused on the inflation story. You look at current inflation trend in Europe is surprising to the downside. In the US is falling quite nicely. That's another reason why central banks can cut and also why sentiment is quite positive. But so the focus is very much around growth. And if against that backdrop, non-farm payroll were to surprise to the upside, alleviating some of the recession fears, which we anyway would lean against that could actually be supportive of markets. But it's the market narrative has been shifting so frequently this year. It's really hard to say, even at this point where is it, Wednesday and non-farm payroll Friday, but who knows, right? There's a lot going on right now. There's a lot going on right now. There is election, geopolitical flare-up in the Middle East, and US data releases. So this focus shifting from inflation to growth, that can shift right back, especially if you look at how energy is responding to the Middle East flare-up. That is actually making interestingly Treasury not as good a diversifier in this environment, which is what we saw yesterday and today.
But Wei, hasn't Jay Powell told us that they only really care about the labor market right now?
They, of course, care about inflation, too. They have two mandates. They can say what they want to say, but at the end of the day, they are able to say that because inflation has been well behaving. Now, what's been driving inflation down coming out of the pandemic? That is because inflation was coming down when pandemic distortion was unwinding. And there is more room for that to play out, and growth incrementally slowing down can also kind of take inflation lower, and the labor market immigration story could also take inflation lower. But structurally, inflation is set to settle at a level that's higher than pre-pandemic levels because of supply shocks coming from geopolitical fragmentation, coming from low carbon transition, coming from over time aging population. So when you have all of that together, it's impossible to say that Jay Powell does not care about inflation.
You just said something that was fascinating. You said that bonds are not as good of a diversifier against some of the risks as they have been in the past, and that yesterday was a good example of that. Can you elaborate? Because we did see oil prices pop, but we also did see a flight to havens, a flight to bonds.
Yeah, no, this is really interesting, and I think that very much speaks to the new regime that we're in right now, which is different from the old regime because we now have supply shocks and structurally inflationary pressure. So you see oil price spiking, you see break-even reacting a little bit, you see markets getting a little bit more worried about that and what that means for bond yields, and as a result, the traditional safe haven quality was not embraced as much, right? I would also observe that even oil, like right now it's going higher, but you look at April, oil price barely reacted. So one has to ask the question, is it fundamentally different right now? The last observation I would make when we're talking about diversification and what worked, what didn't quite work, gold has been behaving reasonably well if you look at the last 2 years or so during times of geopolitical flare-up and market uncertainty. And I think that actually makes it a important consideration from a portfolio perspective.
Wei Li, thank you so much for being here. Wonderful to see you. Wei Li of BlackRock joining us here on set. Right now, let's get you an update on stories elsewhere this morning. Here is our very own, straight from the ports, Bloomberg Brief's Danny Berger.
Hey, Lisa, thank you so much. The death toll from Hurricane Helene has now topped 150 across 6 states and displaced countless others. The federal government reported 29 shelters that are open. They have more than 1,000 occupants. Biden will visit the region today, making a helicopter trip over the flood-hit city of Asheville. He will also visit a rescue command center in the state, and then he will head to South Carolina. Kamala Harris is also headed to Georgia, which was badly hit by the storm as well. McKinsey is pumping the brakes on remote work. Bloomberg is reporting that the consulting company is considering upping the amount of days it expects staffers across Northern America to spend in the office each week. That stricter stance would also likely apply to employees who are in between projects. McKinsey follows several firms that have sought to limit remote work. The first round of the MLB postseason got underway yesterday with 4 games in the wild card round. In the American League, the Tigers defeated the Astros and the Royals eked out a win against the Orioles. In the National League, the Mets overtook the Brewers and the Padres defeated the Braves. The wild card round is a best-of-3 series, so all of yesterday's winnings teams looking to clinch today and to advance to the division series. Today's action starts with the Tigers and Astros with the first pitch scheduled for 2:30 p.m. Eastern. And that's your brief. Lisa.
Thank you so much, Danny. I just want to point out that when John's not here, football's out, and the fact that the Mets, yes, are advancing is on the docket. Up next, Middle East tensions rippling through oil.
We're looking at a market that has been supremely underestimating the potential for all-out war in the Middle East. War is hotter than ever, and oil just continues to trade on a headline.
That's coming up next. This is Bloomberg. Halfway through the week with another day of losses. Good morning. Welcome back. We are seeing the S&P soggy into the open, led down by the Russell 2000, which is underperforming. S&P futures down about 0.25%. You could see a bit of a lift in the euro after yesterday's punishing session, 110.75, breaking below that 111 level, yet still sort of remaining in that level. And crude very much keeping our focus with up now another 3.5% on crude, $72.26. Traded on the NYMEX on the heels of this. Under surveillance this morning, Middle East tensions rippling through oil.
We're looking at a market that has been supremely underestimating the potential for all-out war in the Middle East. War is hotter than ever, and oil just continues to trade on a headline like it did today, but we are well off the highs. So clearly traders are still taking a look-see that things will quickly resolve. We have to keep in mind we must see a disruption in the flow of oil, which we have yet to see.
Here's the latest. Oil prices rising in the wake of Iran's missile attack on Israel. Traders bracing for further disruptions, with Israel vowing to retaliate. Joining us now, I'm so pleased to say, is Bloomberg's Javier Blas. Javier, I just want to start with what's currently being priced into markets and how much of a disruption it could be if this conflict does escalate.
Well, the simple answer is we don't know what the escalation could be, or whether Israel will hit oil installations as the most catastrophic view on the oil market is, or it will be a more pointed response, perhaps similar to April. I do believe that if Israel consults with his allies, and particularly the United States, or even if he listens to the view of China, will indicate that there are two things that they are out of limits for any retaliation. One, oil infrastructure for exports, and two, desalinization plants, because the fear will be that Israel can hit on the other side of the Gulf, attacking those similar installations, say, on Saudi Arabia, the United Arab Emirates. So we don't know really the impact that this could be. I mean, the market obviously was very short going into the missile strikes, and now there is a significant short covering movement happening, a lot of profit taking from people that went short at $80 and taking profits and securing those profits. So it's a bit too early to say what is going to happen in the next 24 hours.
One thing that I love about your reporting, Javier, is that you're good at understanding the psychology behind certain decisions. And I wonder, when Israel is deciding whether to retaliate and take out certain oil infrastructure in Iran, they don't want to do so because it could disrupt things in some of their allies' economies. On the flip side, Iran isn't going to want to, say, block the Straits of Hormuz because it could also anger allies of its country, like, for example, China. How much is there sort of a stalemate that will ultimately protect oil assets versus put these in the target zone?
I think that the biggest problem is the unintended consequences. The more that the conflict continues, and let's remember that we are almost 1 year into the current phase of the conflict, the bigger the risk of something going wrong, that no one really intended to hit something, but ultimately there was a miscalculation and unintended consequence, and oil gets affected. If things go more or less within the guardrails of the two players, I do believe that they managed to keep oil out of the equation, and therefore therefore oil prices ultimately go lower. But I do admit that the longer that this goes, the risk of unintended consequences increases.
Javier, we see this geopolitical risk premium built back into the price, but you have a column out this morning that said the price is now closer to 50 when it comes to the reference value than 100. Explain.
Well, first of all, simple mathematics. You look at where WTI is trading today, around $72 oil. Well, 72 is closer to 50, that is to 100. That is one point. That you have asked me a year ago, 2 years ago, 10 years ago, had Israel taken the leader of Hezbollah, had made Israel an invasion or at least an incursion in southern Lebanon, had Tehran sent close to 200 ballistic missiles into Israel territory, where the price of oil will be, I would have said WTI is going to be trading at $72. I would have indicated something much larger. And there is a second story here in the oil market. There is the story of the geopolitical risk, but there is a story of the oil and supply and demand balances in 2025 and what OPEC is going to do. At the moment, I don't think that there is a need for more Saudi or OPEC oil into next year. However, OPEC has plans to increase production. There is a lot of cheating, and Saudi Arabia is making verbal threats, not so veiled, they're quite public so far, to the cheaters, countries like Iraq, that you need to rein in production. So the politics of OPEC can outweigh the politics of the Middle East between Israel and Iran. And I do think that there is an unappreciated risk that we go a lot lower in supply and demand fundamentals in 2025.
Javier, last week we have a report from the FT that a few analysts poured some cold water on. Do you think Prince Abdulaziz is preparing to really start owning market share and just ignoring the price of crude?
I don't think that the Saudis want to launch a price war because they know the consequences of that will be much lower prices. Prices perhaps that they could derail Vision 2030 in the kingdom. Let's not forget that if Saudi Arabia was to go ahead with something that looks like a price war, let alone a full price war of going to production at capacity, which is about 12.5 million barrels a day compared to 9 million barrels a day of current production, prices will go a lot lower because a lot of traders will see that events through the glass of what we know. And the last price war that we have it in very recent memory, that was in 2020. And let's not forget that it ended not at zero, but it went at a minus 40 WTI. And that's when we started to recover. So I don't think that the Saudis want a price war, but the Saudis are making some threats that they are prepared to take those steps to try to bring countries like Iraq, Kazakhstan, Russia, and also the UAE into line, into complying with the production limits. But then again, very similar with the situation between Israel and Iran, the potential of miscalculation, the potential that something goes wrong, that Iraq calls the bluff of the Saudis, that Iraq doesn't reduce production and then the Saudis feel compelled to retaliate. It increases the longer that this goes. And let's be honest, a lot of OPEC countries have been cheating on their production limits for a very, very long time.
It's called fudging, Javier, not cheating. It's drill baby drill season, though, here in the United States. As you know, it's election season. But I have a question for you about shale break even. The former president continues to say that he will bring oil prices down so low, open up the taps. But what is the break even where he needs to make sure there are still higher prices so that shale companies are profitable?
I think that current prices, everyone is still making money in the oil industry. Certainly not as much money as they were making with prices close to $100. But something around $70 WTI is a price that is very comfortable for everyone. We are not going to have a boom in shale production. Shale production at these levels will slow down. But if I have learned anything over the last 10 years looking at the shale industry, is that betting against the ingenuity of American petroleum engineers is a losing proposition. They will get very good at cutting costs, at drill faster, drill better. So yes, things will slow down with shale at $70. Certainly, we will slow down a lot more at 60 or 50, where we may have a contraction even. But shale has rebounded from every price war, from every episode of low prices, stronger, better, leaner, faster.
Javier Blas, thank you so much for being with us. It's always a pleasure to get your insights. Coming up, do not miss this, our very own Jonathan Ferro sitting down with Apollo CEO Marc Rowan to talk about their ambitious profit target, as well as just in general, how their role has changed in this market. From New York, this is Bloomberg. The middle of the week, and we have possibly a second day of losses. The S&P, the Russell, and the Nasdaq all lower on the day ahead of the open, led down by the Russell 2000. On the heels of both, yes, geopolitical turmoil, but also what we're seeing with respect to jobs. The countdown to the non-farm payrolls really seems to be starting yesterday with that JOLTS report. JOLTS headline number came in okay. If you take a look at the underpinning, though, you see the quits rate coming in at the lowest rate going back to 2020. And Annmarie, more questions about just how much resilience there is in a market that's been hot for a very long time.
I know everyone's excited about this week's non-farm payrolls. The market's looking for 150. Do you take the over? Do you take the under? Unless you're Citi's Andrew Hollenhorst is looking for 70,000. But it's the next jobs report that I think is going to be a lot more interesting. How does the Fed look through the fact that we already know it's going to be a soft labor report? If you look into the fact that we have a strike at Boeing, strikes at the docks, and also the effects of Hurricane Helene.
If you bleed it through the bond market, you do see a rally, a bid into bonds that was yesterday carrying through to today on that risk aversion, as well as, although it has flipped around with a little bit of a lift just across the board. Some Somnolent, though, ahead of Friday's report. Two-year yields 3.61%. In the currency market, an interesting story today with Japanese Prime Minister Shigeru Ishiba saying that the economy isn't yet ready for further interest rate hikes, really taking a more dovish tone, similar to what we heard earlier today also from Bank of Japan Governor Ueda. Basically, this question of just how much are they going to normalize? You are seeing a bit of yen weakness, 144.80. In the dollar space, you are seeing a bit of dollar softness across the board. In the euro space, 110.72. Right now, I want to head over to an interview we all are very much looking forward to. Jonathan Ferro just hightailed it out of here to head over to Apollo, sitting down with Marc Rowan, who is the CEO. John, take it away.
Lisa, thank you. This was the deal. We agreed to it. If the stock closed at an all-time high on Invest today, Marc Rowan would show up alongside me, and he's a man of his word. Marc, good morning. It's good to see you.
Thank you. And technically, you're here. You came to visit us, so thank you.
Thank you. You planned it this way, I'm sure. Big target for 2029, $10 billion of annual earnings. I think we have to start with a pretty broad question. Rates are coming down. Economy's pretty decent. Let's just call financial conditions easy. Why are people coming to you instead of just issuing a bond in public markets?
I think if they come to us when they can't issue a bond in public markets. And can't is not that it's not open. It's that they want to do something that the public markets will not allow. Public markets over the past 2 decades have become very vanilla. Call it beta. If you want to do something unique, if you want to finance the next generation of infrastructure, you want to build a project, you want to build data centers, you want to build power, you want long dated, you want special features, that's just not available. You come to someone like us, and increasingly, private markets are offering really compelling solutions to investment grade borrowers.
Let's talk about some of those deals. AT&T, AB InBev, Intel recently. What's the common theme behind those 3 companies for you?
The common theme for us is excess return relative to the credit of the underlying borrower. The common theme for the issuer is they are achieving something they could not otherwise achieve. When we did AB InBev, some $6 billion years ago, everyone around us, our peer group, that was interesting. That was one-off in COVID. You'll never do another one, another investment-grade private deal. $100 billion later, we're still doing investment-grade private deals. And I see nothing but a long line of interesting borrowers and interesting situations, because think about what we're doing in the world today. We are building infrastructure. We are building and changing energy transition. We're just at the beginning of this. And we are building the next generation of data and power. Every one of those things is long dated. Many of them are complex financings. Some will go to the banking system. Some will go to public markets. But increasingly, For these more complicated financings and long-dated financings, private market investment grade is where borrowers are coming.
There was a theme in Investor Day, and you've talked about this with me yourself privately. Global industrial renaissance. What are you talking about?
We're talking about just this massive need for capital. I mean, you can believe or not believe all the figures that are out there, but when you add up the amount of money that is needed for energy transition, the amount of money that is needed to fix our infrastructure, the amount of money that will be needed to build data centers and power to supply them, much less to connect and redo our power lines, you're talking about the amount of money that's been spent since the invention of fire. All with a backdrop of the U.S. government borrowing $2 trillion to finance itself on a current basis. This is not a question of will private markets grow. The question will be how much. Yes, public markets will continue to play a really important role, banking system, really important role. But this tool, this notion of private investment grade, has really not been available to CFOs or others arranging financing, and increasingly it will be.
How labor intensive is this for you? And as you do more deals, do you get a benefit from that you are able to replicate things and use less and less people to scale up?
The scars of experience.
Yeah.
So these are all labor intensive, and that is actually what the competitive advantage is. The investment grade bond market became so efficient and so low cost that financial firms stopped allocating resources to it. There was just not any money in doing that. And so the market is very available, but it is very plain vanilla. Almost no one has built what we've built. When you look at employment at Apollo, the greatest group of employment, 4,000 people, some $8 billion that we've spent over the past 15 years, all goes to what we call origination. Now, not all of these originators are out calling on investment grade borrowers. Some are running other types of origination vehicles: aircraft finance, fleet finance, receivables finance, inventory finance, infrastructure finance. Increasingly, this is how America borrows.
Introduce Citi and a $25 billion partnership. What's behind that? Is that an acknowledgement from you that you've got more cash than you know what to do with?
I think it's an acknowledgement that origination, the control of the product, is actually what has value. And some of that origination we're going to build ourselves, and we've built more of it than any. But let's face it, a whole industry is short origination. To the extent we can find a meeting of the minds with Citi, that's fabulous. And I think the bigger theme here is the banking system, particularly one of the big four banks, is actually figuring out what we believe all along. We don't want what the bank wants. We don't want the bank's customer. We want the asset. The bank, we can't offer advice, M&A, derivatives, hedging, foreign exchange, payments, credit cards, or any other service. The bank wants to offer those things. The bank sometimes wants the loan, but more often than not does not want the loan.
Who do you think fielded the most calls that day when that was announced, that partnership? Was it Jane Fraser and annoyed asset managers, or was it you and annoyed bankers?
From the comparing of notes last night, it was Jane.
It was Jane? Did you get the calls yourself from other banks?
We definitely got a few calls.
Do you get the sense that this is the beginning of something bigger? 25 billion is the number with Citi. Just give me an idea of what this looks like further down the line. Does it include other banks too?
I think it does. And now, I think it is difficult to serve lots of people in the same way with the same terms, but the Citi partnership is focused on a certain type of borrower. I think you'll see international partnerships. I think you'll see investment grade partnerships. I think you'll see infrastructure related partnerships. I do think that we are becoming a partner in some ways to the banking system rather than how it is portrayed in the press, which is, a fierce competition over everything.
This conversation so far has really been about how the financing of companies, particularly in this country, is changing, how the companies doing the financing is shifting, the emphasis being on private markets. Part of your vision is how investing is going to change as well. So let's spend some time on that. How is investing going to change? How do we think about public versus private now? And how do you hope we're going to think about it in years to come?
Look, for me, this is year 40. It's sometimes hard to believe I've been doing it this long. But we grew up thinking private was risky and public was safe. And probably 40 years ago, that was true. Private was three products: private equity, venture capital, and hedge funds, all three of which can be risky, but done the right way are excellent investments. And public was 8,000 public companies, diversified portfolios of stocks and bonds. Let's just say that's not how the world is today. The world that we see, private is safe and risky, and public is safe and risky. And if that's true, Everything we know about portfolio management, the way we construct portfolios today, is going to change. Think of the typical investor. A very bland, I say a 3-flavor ice cream portfolio.
Sure.
Stocks, bonds, and a little bit of alternatives. Why? Well, because when something is risky, you put it in a small bucket called alternatives. You watch it carefully, and you demand high returns out of it. But if private is just another form, I think what you're going to see is the whole business of what I call replacement. Fixed income, which today means investment-grade public credit, I think is going to be investment-grade public and investment-grade private. 18 months from now, I do not believe investors will actually know the difference between investment-grade public and investment-grade private. It will not be the issuers, it will not be the size, it will not be the ratings, it will not even be the liquidity. Everything that exists in the public markets, repo, borrowing, market making, daily pricing, is coming to the private markets.
What is the total addressable market? What kind of numbers are we thinking about?
We're talking about massive marketplace. When we look at the entirety of our industry, has been built out of the alternative bucket of institutional investors. The fixed income bucket, which is the one I'm talking about now, is 50% larger than the alternative bucket and is mostly 100% public investment grade.
Equity, different to debt. Can you tell me how that's going to be transformed and whether some of the companies that typically would be going public are going to stay private? Whether we're going to see a big shift in capital markets over the next 5 years or so on that front?
Well, we're seeing it already. So this is a two-pronged answer, which is 8,000 public companies is now 4,000 public companies. Fewer than 100 companies go public every year and more than 100 companies go private. There do not seem to be compelling reasons for companies to be public, particularly with what's happened on the investing side. So much of our market today is indexed and correlated. Think of passive now 60-70% of the overall marketplace. Active management, which historically has been the buying and selling of stocks, has really been a very, very difficult place to be, has failed to beat the index 90+% of the time for 20 years. I think we're going to see an evolution also take place in equity. It's going to happen more slowly. In fixed income, we are going to see fixed income replacement. Public and private essentially come together. And the reason I know that is we're seeing it every single day. And in fixed income, we have arbiters of credit quality, rating agencies, who tell investors that something public and something private is of the same quality. In equity, we lack those arbiters. But nonetheless, I think investors are beginning to understand when 10 stocks are 35 to 40% of your portfolio, and 4 stocks have determined all your returns for the past 4 years, and 1 stock has basically been 100% of your quarter. I mean, think of what we've done as a country. We've taken the largest pool of savings in the world, 401k, $12 to $13 trillion, from a group of people who need retirement savings more than ever. What do they own? They own daily liquid stock index funds, generally S&P, for 50 years. Why? Well, we have a mistaken belief that public is safe and private is risky. You look at the best retirement system anywhere in the Western world, in Australia, where they've introduced superannuation 40 years ago. Just a fancy way of saying is they gave the equivalent of 401k investors access to private markets. The returns have been nothing short of spectacular. Outcomes for investors can be not a little better, 50 and 60% better.
You know the view here, public is transparent and private is opaque. How do you change that view?
Well, I think it's going to happen in fixed income. I think when you get to daily pricing, when you get to daily liquidity, when you can see a market, but let's not fool ourselves. Markets are different than we think they are. Everything changed in 2008, as it should, as a response to the financial crisis, but we just did not experience as investors those changes because right after we changed the rules, we printed $8 trillion and everything went up and to the right. One of the most interesting things that changed, there is no liquidity in public fixed income. The stats I've seen, it takes 5 days to sell an investment-grade corporate bond. So when you see a quote, is that liquid? Well, we feel good because it's public, it's there, we can see it. I do think we're going to end up not caring in fixed income in the next 18 months as to whether something is public or private. The comfort that people are developing in private markets on the fixed income side, I believe will eventually extend to equity, and we will see equity also adopt private side by side with public. As I sometimes joke, investors will own equity that is private rather than private equity. The difference being the leverage.
You say we, you mean investors. Do regulators see it the same way?
I think they do. I mean, the conversation with regulators is actually a fascinating one because clearly change is scary. But the typical conversation is every dollar of borrowing that moves outside of the banking system to the investment marketplace. And let's face it, there are only two choices for regulators. Money in an economy can come from investors or from banks. There's no third choice. So every dollar that moves actually delevers the banking system and makes it safer. And people recoil in shock, and this is just math. A bank is levered 12 to 14 times. The typical institutional investor is levered 0. The typical mutual fund, levered 0. Typical BDC, levered 1.5 times. Typical retirement services company, levered 8 times. It is deleveraging. The second is disclosure. We think it's not transparent. The typical bank disclosure says loans to customers and loans to companies. You click on our website, you can see every security we own every quarter. Then you talk about maturity transformation. Maturity transformation is really where the economy has suffered and financial markets have suffered. Banks are in business to do maturity transformation. They borrow short in the form of deposits and lend long in the form of loans. That's not a bad thing. That's just how they're set up. In the investment marketplace, generally you're talking about investors who are matched from a maturity point of view. And the final thing that I always sit with regulators, what percentage of assets in the US banking system are investment grade? They don't know. We have a perception that they're all investment grade, but the reality is about 60% of bank assets are investment grade. You look at a balance sheet like ours, and just as an example, we're 90+% investment grade. And so it's change, but it is actually change that is making the system more robust and more diversified. And we, let's make no mistake, we are the envy of the world. We, the US, are the envy of the world. In Europe, they are squeezing the banking system through Basel Endgame, but they haven't yet decided to allow investors to fill that gap. And there are questions. Why are we struggling with financial markets? Well, you're squeezing the banking system and you're not allowing investors to fill the gap.
Have you had this conversation with the senator from Massachusetts? Has that conversation ever happened?
It hasn't, but I welcome it. I spend lots of time in DC and elsewhere speaking to regulators because we are in a really dynamic phase. Everything that we think works the way it works has changed. And we're about to experience and are experiencing the changes that were made in 2008 in response to the financial crisis.
Speaking of changes, Washington, D.C. is becoming increasingly interventionist. You compared some of the benefits of doing business in America and doing business in Europe. Doing business in America is arguably not as easy as it used to be, and it may well get harder. What's your view on where we're heading?
You may be right, but it's all relative. This is the single best market to be in at this point in time, bar none.
When we spoke before Christmas and we talked about the choices on the menu then for the upcoming election, you weren't too impressed. The menu's changed a little bit. What's your view?
Since I'll be under banishment here if I give you a direct view, let me just say, the way I frame this is you are either more scared of 4 years of the status quo or more scared of 4 years of change. You just have to decide what you're more scared of. Me personally, I'm more scared of 4 years of the status quo.
What's wrong with the status quo?
I see a direction where the trend is not our friend. Right now, we are, as you suggest, we are the single best place to do business in the world. We are the luckiest people in the world. Can we screw it up? Yeah, we can. The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
Do you see anyone on the campaign trail that's willing to do anything about that?
On the campaign trail, no.
In reality?
Let's hope. All we can hope for is better governance.
I've said repeatedly on Bloomberg Surveillance, on Bloomberg TV, on Bloomberg Radio for years that America has the privilege, the unique privilege of acting recklessly. Are we losing that?
Not yet. We have a long way to go. We have lots of examples around the globe of people who have acted recklessly for a much longer period of time than we have been acting recklessly. But we also have obligations that others do not. Right now, we are the beneficiary of being the strongest economy, the strongest capital market, the strongest military, and the best place to do business. I mean, if you tick off what's happened over the past years here, we may not like how we got here and how we financed it. 3 years ago, we decided to build infrastructure. We allocated $2 trillion. None of that's built yet. It's all being built. 2 years ago, we spent $52 billion of semiconductor subsidies to build semiconductors here. Not a single plant is open. It's all being built. A year ago, Inflation Reduction Act to encourage the manufacture of renewables. 1.3 to 2.3 trillion. No one really knows. Not a single plant is opened. We are the beneficiary and the largest recipient of foreign direct investment 3 years in a row. So people around the globe are actually figuring out we're better off here. And something tells me we're ramping defense production. All of those things are fiscally stimulative and positive for employment. Oh, by the way, we have no illegal immigration. This sets us up very well fiscally for a strong economy, which I think we're seeing.
Federal Reserve is cutting interest rates by 50 basis points. Are you in Torsten's Slot camp? And you can agree or disagree with Torsten, of course. Torsten works here. He believes this economy doesn't need rate cuts. We're in a great place. Do you share that view?
I said it right. I was, I guess, unfortunate to be on TV an hour after the rate cut. I said this was a very, very expensive insurance policy.
What's expensive about it?
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet we're stimulating, and we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time. And to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter, to the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now. So am I in the Torsten camp? I'm absolutely in the Torsten camp, and it's my privilege to have him down the hall. I make sure to check in with him every morning.
I do as well. Marc, Rowan, this was a privilege, a pleasure. Good luck for the next 5 years, and I hope to talk to you every year.
Every year you get to do it. Thank you.
Marc, thank you, sir. Appreciate it. Lisa, we'll come back to you in the studio here in New York. Thank you.
John, great work. Fascinating interview, very wide-ranging, from the political sphere to the change in markets, the idea that people will be talking about equity that is private, not private equity. John, wonderful work. Thank you so much. A lot of interesting moments there, Annmarie. I know that you picked out one in particular with respect to the deficit. He didn't talk about, Marc Rowan didn't talk about which candidate he does support by name. He did say you're either scared of 4 more years of the status quo or 4 years of change. He personally is more scared of 4 years of status quo because of how much the U.S. is spending versus what it is actually saving and preparing for the next generation.
And from where he sits, he's saying that he's not seeing yet the benefits of that spending. And he says that the U.S. right now, there's no governance when it comes to the fiscal spend, and we are just wasting our children's futures. His words. It was interesting, though, because he didn't name names, but he clearly was backing one camp when it came to the Trump camp, because he said, you're either scared of status quo or scared of 4 years of change. Also very interesting, expensive insurance policy, the most expensive insurance policy when the Fed came out and cut 50 basis points.
Yeah, sitting basically where Torsten Slot is, saying that essentially this is not an economy that needs some sort of stimulative, pre-active insurance cut, given how much momentum there is currently in the labor market. This is highly disputed. We heard Neil Dutta yesterday, Renaissance Macro, coming out and saying the Fed should cut by 100 more basis points. The case is obvious. You have people on both sides of the map. Taking it back to markets, what we're seeing is a little bit of a weakening across the board, led by small caps, and actually the Russell 2000 continuing to decline, deepening those losses, down 0.8% on the heels yesterday of both some labor market indications that were weaker than expected and the turmoil that we're seeing overseas in the Middle East. We're talking in particular about that quits rate that came in from the JOLTS report at the lowest going back to 2020. Also some weaker than expected trends in the ISM manufacturing data under the hood when you look at the employment factor. I wonder how much this is really driving the bus, Annmarie, when you look at the action. And a real question here about whether you can continue to see a broadening out in the equity rally if you don't have that same kind of strength continue, at least in the day-to-day data.
What we saw in the data, I think, was reflective of what we recently saw on the conference board. And this is what Oxford Economics was talking about, the quits rate falling to the lowest level since the pandemic. The decline is consistent with other data showing workers view the labor market less favorably. That idea is, are jobs plentiful or are jobs hard to find? We'll get a better read on Friday. Of course, we'd like to talk about the fact that you pretty much need to slice off maybe 60 or 70K because of revisions. But I still think the next labor market report the two is going to be so much more interesting because of how difficult it's going to be for the Fed to maybe read because of all the issues that are happening when it comes to Boeing, when it comes to dock workers, and of course when it comes to the hurricane.
In the meantime, what you're seeing in the bond market is a little bit of a lift in yields, even though you are seeing a bit of a risk-off tone, sort of the opposite. Wei Li was talking about this earlier, how it's an unpredictable diversifier when you take a look at the bond space. 10-year yields up about 3 basis points, 3.76%. The 2-year yield up just a basis point, 361.47. A real question here about how much people can pile into bonds, given how much we've rallied and given how much of a rate cutting cycle we have already been pricing in. That is going to be a key question going forward, especially given some of the other side of the aisle, which is actually what Marc Rowan was talking about, this idea that we are seeing a no landing, right? I mean, how many people are coming out and saying, look, this isn't an economy that's that weak? At what point do you start to see the bond market reflect that maybe it's hitting up against its limits?
And to Wei Li's point, when I push back on the fact that it's obvious from the Fed's point and Jay Powell's point, they care a little bit more about the labor market right now. They don't want to see the deterioration when it comes to jobs. But there is this concern from some individuals in the market that you could see a reacceleration of inflation. And the stories right now do not bode well for that potential scare when you think about what's going on in the Middle East and the fact that we did see a jump in oil prices yesterday, even though there seems to be some ceiling on how high they could go. And then, of course, potentially supply chain bottlenecks that are coming out of the East Coast.
Meanwhile, what you see in the currency space is kind of a confusing picture, although dominated by Japan, given the fact that the new Prime Minister, Shigeru Ishiba, came out and actually tempered expectations for further rate hikes, saying that the emphasis has to be on the strength of the economy. What you are seeing is the dollar strengthening versus the yen, ongoing yen weakness after a bout of real yen strength, 144.74. It's not massive, which I actually find interesting. So it really highlights maybe a positioning equilibrium that we didn't see maybe a couple of weeks ago.
You got to think all in a day's work. Brand new prime minister, 24 hours, got to call the president of the United States and got to make, maybe some potential moves in the currency market.
Well, in fairness, if you think of the decade or several decades of disinflation or deflation, you understand why they're so focused on this. We'll carry the conversation forward. Coming up, Kristen Bitterly of Citi will be joining us, Aneesha Sherman of Bernstein, Joe Davis of Vanguard, Tony Rodriguez of Nuveen, as we count you down to non-farm payrolls on Friday, leading off with ADP in just about 15 minutes' time. This is Bloomberg.
Stocks have been benefiting from this whole view that rates are going lower.
As much as the data becomes more and more muddy, there's a risk that continues or even exacerbates over the coming months.
While we're not expecting a significant slowdown now, we do think you're coming into a third quarter low.
We do think that the economy is much stronger than people expect.
The upside opportunity here is tremendous.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. John is hanging out at the Apollo's food court for just a little bit longer. Still in the room is Annmarie Hordern, as well as Danny Berger. Thank you both for being here. I am looking right now at a market that is slightly soggy ahead of that ADP report in about 15 minutes time. Let's begin. Let's get into it. This question of just how weak or strong is the labor market. That is the focus. Possibly, Danny, what's driving down Russell futures, given the fact that that was really the main message that came out of yesterday's report.
I'm just interested in what happens to yields. I think you put it so right at the end of the last hour that we retained this risk off except for bond yields. Is it just a feeling that so much is already priced in, that we have crisis era type curve already? So what does that mean if we get weaker jobs data? Does it initially lead to, okay, we rush and buy bonds, and then we kind of say, hey, maybe everything's in here that we can be? What will be the reaction? Are we just set up asymmetrically at this point?
That's a great point. Asymmetric. Is there an asymmetry right now in markets? Because we have baked in so much of a rally in bonds. Yesterday, a lot of people flirting with the idea that maybe we saw bonds act as a stabilizer, that they were actually the haven asset, not only with the weaker economic data, but also given the fact that there was this disruption in the Middle East. You saw oil prices tick up, might be inflationary, but you still saw a flight, at least on the margins, into bonds. Annmarie, there's a question here about how much this market is accounting for or discounting some sort of potential escalation.
Yeah, and there's really three main stories right now that can affect the U.S. economy: the hurricane, the dock workers, and then, of course, this geopolitical tension in the Middle East. And we are still waiting on a response from Israel. So potentially you're seeing some of that risk definitely baked into the oil market. And it's a big question mark on whether or not it ends here or does it escalate further.
And at a certain point, you start wondering about that. Danny, I know you're very familiar with the dock worker strike. You spent all of yesterday and the day before hanging out with the seagulls. How was that? Was that fun?
Too many birds.
Yeah, too
Honestly,
many birds.
a terrifying amount of seagulls around there. But no, it is a feeling that the sides are moving closer together and maybe something will happen that makes us forget about all this. It's the trend of really the past 2 months. August, you start with bad news. There's the risk of a hard landing. September, it was inflation. And then at the end of both months, you get this big risk on rally. Is this month the same, where we start worrying about geopolitics, we worry about the dock workers, and then next thing you know it's risk on yet again?
Well, we heard from Bloomberg Economics, Anna Wong, talking about the fact that this might mean 80,000 off the payrolls, and that could boost the Fed to go in with a 50 basis point cut. So this could mean from dock workers to the Fed, there's actually an implication.
All I can say is you wait 2 minutes, we'll get another narrative, and we'll be tracking all of them for you here on Bloomberg Surveillance. Coming up this hour, Kristen Bitterly of Citi Global Wealth Management as a risk-off mood grips markets. Aneesha Sherman of Bernstein as Nike scraps guidance amid its CEO shakeup, and Joe Davis of Vanguard on the loss of momentum in the U.S. labor market. Let's begin this hour with stocks on hold. Investors keeping an eye on the Middle East and awaiting more U.S. labor data ahead of payrolls Friday. Kristen Bitterly of Citi is saying this: geopolitics and elections are big concerns, but not really driving investment decisions. Reinvestment risk is becoming more real. The 50 basis point cut actually mobilized a lot of capital. Rolling T-bills is becoming a difficult strategy to compete with the returns that we have seen in equities, with further broadening out. Kristen, I am so pleased to say, joins us now. Kristen, is this basically an argument to all of those people who have $6.4 trillion in money market funds to say, really? Really? Are they actually moving?
There is a lot of cash on the sidelines, and we've actually seen a substantial amount just within portfolios. And I do think it makes sense. Cash was a viable asset class, and we needed some movement from the Fed to actually start looking and analyzing the rebalancing decision. So what have we seen from investors? We've seen them coming into equities. We've seen them coming into the fixed income market more broadly, whether that's in munis, in investment grade corporates and extending duration, or in preferreds. But I think what happens is in a lot of our conversations, people will talk about geopolitics. They'll talk about elections, but then they take a step back and they say, earnings are at record highs, rates are coming down, inflation is coming down. And then I would even add what China did last week, not saying that we're seeing retail investor flows go into the Chinese market, but more that It's one more thing, one more tailwind.
You know, I do wonder, though, I mean, just to sort of put this in perspective, we're about 10 minutes away from the ADP employment report. Yesterday, we got quits data underpinning the JOLTS information that highlight that people aren't feeling comfortable to quit their jobs in the same levels that they were back in 2020. Does that give you pause?
I think the labor market data that we've seen thus far has actually, and I agree with Chair Powell on this, there's some slowing, but it's not contraction. It's not deterioration of the labor market. And so Friday is going to be really important. I think payrolls are going to be one data point that everyone's watching, especially because what the Fed is telling us is that inflation, that battle has largely been won. So now all eyes on the labor market. I do think, though, there are so many things that will go into that data, whether that's what Annmarie actually just mentioned a little bit ago, whether it's the dock workers strike, what we're seeing with the impacts of the hurricane, what we're seeing with various strikes. So there's a lot of noise in that data. And the question is, does the market and the Fed actually look through to that noise and understand what the real picture is?
What are you telling your clients? Should they be looking through the noise? Should they care about the labor market data? Or should they look at China, maybe 100 basis points of cuts this year, and say, hey, go full on bullish?
I actually think there's opportunities both within fixed income as well as equities. And when you look at our portfolios, they are very balanced. I think everyone looks at October, and we could discuss this ad nauseum. October tends to be a volatile month going into election years and tends to be a negative month. So whether that's elections, geopolitics, we could debate that. But I think when you look at, like, what is your plan for your portfolio, there are opportunities within fixed income markets, whether that is munis, whether it's preferreds, whether it's investment grade corporates, and finding opportunities in extending duration. Within equities, we have been playing this broadening out story, but still leaning into quality. So for example, an area of the market that has been left behind, dividend growers. So strong balance sheets, strong free cash flow generation, but they haven't been on like either side of high-flying tech companies or when small caps catch a bid. So for anyone looking to kind of hide out and still have equity exposure, that's a great place to be.
For every tailwind you're talking about, there seems to be a risk, though. The geopolitics in the Middle East, the election uncertainty, it's on a knife's edge, Boeing, dock workers, hurricane. Where else do you think you can hide before what is potentially going to be a very few long months or weeks when we might be questioning the outcome of this U.S. election?
So I think the U.S. election, we always say that it's policy, not politics, that are going to drive any type of investment decision. And so what we've tried to do for our investors is say, like, what is the playbook, right? So you basically have 3 different outcomes in the election, whether that's a Dem sweep, a Republican sweep, or what most people think is going to happen is some type of divided government. And then you look through to, well, what are the changes that could actually happen? And it's tariffs and taxes. And so for each one of those areas, you could have slightly different positioning within your portfolio. But what I just mentioned in terms of what is a way to stay invested in a relatively, you're involved in this equity market that we've seen, but you're doing so with a balance to fixed income as well as equities. And you do have a bias towards some of those areas that are quality that have been left behind. And I think that's a very effective way to be hedged, but positioned going into the election.
In the aftermath of elections in Europe, we've seen one real trend, and that is taxes. The UK, there's a lot of language about carried interest tax. In France this morning, we understand that they are going to also announce additional taxes, trying to tackle the deficit. Michel Barnier, the PM, called it the real sword of Damocles, is the financial burden from the deficit. Are your clients worried about, after an election, the same thing happening to the U.S., that there's a serious conversation about the deficit and wealth planning needs to look different because of potential taxes?
So I think the major conversation that we're having, taxes certainly, and what happens when we get that expiration at the end of 2025, and what that could mean for personal taxes, what that could mean for corporate wealth taxes, dividend income taxes. So there's a lot of discussion around it. But one thing that I think is actually a pretty fascinating stat is you can worry about what those outcomes are. You could worry about what a divided government would do. But I actually look much more basically at the fact that only 1 out of 3 Americans has a will. Like, only 1 out of 3 Americans has actually gone through a financial plan. So when you think through what could be some of the biggest events in terms of impacting your overall wealth and the taxation of that, it's not just what you're invested in, it's how you structure it. And so I would say almost focus more on the basics that are in your control, not this outcome that is something that we still don't know and it's still uncertain. So be prepared for it and be prepared by actually taking control of those things.
Basics like 60-40, basics like having some sort of longer-term risk exposure. This is sort of at the heart of the question that Annmarie and Danny is getting to, which is essentially, do you still go to the traditional 60-40 at a time when you do have the deficit as a concern, where you do have potential more volatility and inflation and potentially geopolitical tensions? How much are you advising clients to diversify away from bonds as that ballast, as we were just hearing from a number of different people, including Wei Li earlier this morning?
I think everyone's situation is unique as to what is their starting point. And so if you look at different profiles of investors, we do see investors who are significantly overweight cash. What do we know is if rates are going to continue to come down, cash is not a good performing asset class. And so that conversation is going to be one where you're trying to find opportunities within fixed income, because someone who's been significantly overweight cash, they're not going to jump into the equity market. They're not going to jump into alternatives. So I think you have to be realistic about what does it look like to get you to better financial outcomes over time. But certainly for investors who are looking through to the equities market, we see a lot of balances where it's 60-30-10, where it's, you have a position in cash, you have a position in bonds, and then you're benefiting from the equities market. And I know that you guys just had the conversation with Apollo too. I think another interesting thing is the relative perceived riskiness of adding some things like alternatives. When you actually look through even to the fixed income market, once you get beyond some of those very, very liquid instruments, there's a lot of illiquidity within the bond market. So you have to think about what is going to ultimately generate the returns that I need to achieve my objectives. And alternatives are certainly an important part of that as well.
Kristen Bitterly, don't be a stranger. Thank you so much for being with us. Kristen Bitterly of Citi Wealth Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. JP Morgan is planning to open new branches across low-income areas in the U.S. The Wall Street Journal reporting the bank is working to build around 100 new Chase Bank locations in America's inner cities and rural areas where the presence of banking has been shrinking. The push is being described as a way to offer a more stable alternative to high-fee services, such as check cashers and payday lenders. Less than a month after its big Glow Time event, Apple is already preparing for its next product launch. According to people familiar with the matter, the company is preparing to announce a new low-end phone early next year alongside upgraded iPads. The new iPhone SE, codenamed V59, will become its new entry-level model. The release will mark the first update to the SE since 2022, when Apple added 5G capability to the device. This will be very exciting to people who have kids and need to replace them. And you could own a piece of GOAT history. Super Bowl champion Tom Brady will sell 47 pieces from his collection of watches and sports memorabilia to Sotheby's, New York. The pieces will be sold at an auction on December 10th and are expected to sell for up to $11 million. Which of you decided to put that in the brief? I'm just wondering, did you end up buying this?
These watches,
Yeah.
this Patek Philippe is pretty nice. But I love what Tom Brady says here. I'm excited to give fans and collectors a chance to own and cherish these special pieces from my journey.
Because I'm sure so many fans can afford that.
I'm sure. I would love to give you the opportunity to experience my life, too, for $11 million. Up next, the morning calls, plus Aneesha Sherman of Bernstein as Nike begins its C-suite transition. That's coming up next. This is Bloomberg. It's the moment you've been waiting for. We got the ADP report, and with us here is Michael McKee to break it down for us. Mike, drum roll, the big ADP report. What did we get?
Better than expected.
Oh,
How's that?
great.
Does that live up to your expectations there? ADP comes in at 143,000 private sector jobs for the last month. That's up from 103,000 revised for the month of August. Most of that seems to have come in the service providing sectors, as one would expect, 101,000 jobs there. Leisure and hospitality, 34,000. Education and healthcare services, 24,000. Now, the leisure and hospitality is interesting given the seasonal aspects of it, but that's what they say they found. Construction, 26,000. That's still adding workers. There's still a lot of demand for construction workers. Manufacturing, they say, added 2,000. They've seen a lot of deterioration in manufacturing hiring, but we haven't really seen that overall yet. Their pay indexes, job stayers saw their pay go up 4.7%, job changers 6.6%. So for whatever it's worth now, we look forward to, on Friday, the payrolls report. Remember, this is only private sector jobs, and private sector payrolls are forecast to go up 125,000 on Friday. So ADP coming in more optimistic than the economists are about the non-farm report.
Right now, seeing in markets a little bit of a pop, particularly at the front end in terms of yields, lower on price as people look at what the potential is for the Fed to make a move with this outside surprise. Not a big amount of drama. Let's just be really clear here. You're basically seeing a lot of fading pretty quickly of this move. But I do wonder how much, Mike, to Annmarie's point, the newfound love for ADP that somehow is more closely correlated to what the revised numbers look like out of non-farm payrolls than, say, non-farm payrolls.
Well, it's like that meme of the guy with the two women and he's looking to the other one when he's with one. ADP was nothing, and now all of a sudden, because the Fed says it's watching ADP, it's watching the labor market, then people are paying attention to ADP trying to get a beat on what might happen on non-farm payrolls. But the ADP people tell you straight out, this is not a forecast. This is just our own number that we get.
To that point, Powell on Monday, I thought the really interesting part of his discussion was when he basically was talking about the tension between consumption and labor markets. And he basically said, look, we care more about the labor markets. They give more of a real-time indicator than something like GDP, which historically can't call recessions very well. With that in mind, Does it mean we need to pay more attention to ADP? How should we, trying to get in the head of the FOMC, approach all of these labor market data points?
Oh, all the labor market data points, as you say, most of them you can ignore. The ADP gets traded because it gets traded, and that's just been its history. And it doesn't, as they say, predict what will happen with non-farm payrolls. And even if it did, it's the non-farm payrolls numbers that's going to matter. And it's usually, unless there's a clear trend, it's usually the payrolls report before the Fed meeting. And we get that November 1st, the next payrolls report. And as Annmarie was saying earlier on the show, that one could be all screwed up. So that could be hard to read. So I would look past this. We'll see what happens on Friday, and we may end up looking past that as well.
Michael McKee, don't be a stranger. Thank you so much for being with us. Always great to get your insights. And you are seeing that sell-off in the bond markets continue just marginally on the heels of that ADP report. Time now for In the Morning calls with just one stock in focus, Nike. First up, CFRA downgrading the company to hold, citing increased competition and lack of growth drivers. Next up, JP Morgan lowering its price target to $77 and keeping a neutral rating, saying turnaround plans are taking longer than expected. And finally, UBS raising its price target to $82 while maintaining a neutral rating, calling recent weak earnings unsurprising and saying the risk reward is balanced. Joining us now, Aneesha and Sherman of Bernstein, sticking with an outperform rating, saying this: though we remain positive long term, we expect the stock to stay in limbo short term without a guidance clearing event or investor day catalyst. Aneesha joins us now. Aneesha, explain. There's so many people who are so bearish on Nike, especially at a time where they're withdrawing guidance, seeing another significant decline in their sales in the third quarter. How are you bullish?
Nike's in a very different place right now than it typically is in the cycle, as well as a stock. Sentiment is extremely low. It is an extremely uncrowded long. It's actually at the bottom decile of our crowding analysis, meaning it's the bottom 10% of uncrowded longs. And so this stock is poised to rebound on any signs of good news. And we saw that happen over the last few months. The stock's been up almost 20% in the last couple of months on expectations of a CEO change and then the actual announcement of the CEO change. But, it's where it's at these levels, any kind of incremental good news helps the stock. The problem is right now the CFO is just wiping the slate clean ahead of the new CEO. So there's no guidance, there's no investor day, or the date hasn't been reset yet. And there's no one in charge. There was no CEO on the earnings call last night. So essentially the message from management is we got to wait until there's somebody in charge again, and then we'll give you some clarity on the upcoming catalysts. And so for now, I think the stock stays a little bit stuck at these levels. But I do think over the next 6 to 12 months, there's some really nice upside as we start to get clarity on the numbers.
Aneesha, I just wonder what you make of that strategy. It's almost as if they're like, we don't know what we're doing and we're just waiting for a savior to drop down from heaven to save us. I mean, is that the right thing, the right approach for Nike to be taking at this moment?
I absolutely agree. I think it was widely expected that the investor day would be postponed and that guidance would be cut. However, the investor day has now been postponed with no rescheduled date, and the guidance has now been completely pulled. And so rather than having rebased expectations for the new CEO to come into, we now have no expectations. And so it's more of a black box than a clearing event. And that's, I think, the issue is I would have liked to see them cut the guide and not just pull the guide entirely. And I would have liked to see a new date set for the investor day so we have a clear idea of the catalyst path. And now we just don't.
But Aneesha, what if that next catalyst is deeper into the abyss and not to the upside?
It's possible, but I mean, if you heard the commentary on the call last night, it sounds like there's a lot of upcoming signs of positivity. Where they're getting better retailer feedback, they're getting better order books for the spring than what they had in the fall. They're seeing their running products coming back and getting double-digit growth in order books. So they are seeing improvements. The problem is they're still doing a ton of clearance on the big lifestyle franchises, on Jordans, on Dunks, on Air Force Ones. So that is an overhang on the sales performance. So until that stops and clears away, we're not going to see that underlying performance work. But the market is going to look for signs of that underlying improvement. And as we start to continue seeing signs of that underlying improvement, the stock will work before the sales performance does.
I'm a runner, Aneesha, and I see it firsthand. There is a war among running shoe providers, and you can see that it right now is being won by the likes of Hoka and On and Asics, if you're me. But I do wonder, from your vantage point, how successful a Nike is going to be and who they're going to get market share back from if they are successful at getting back into the running sphere.
Nike has lost a ton of share in running. We estimate they've lost 1,000 basis points of share, but they're still the number one running brand. I mean, they were close to 30% market share. Now they're below 20%. And the gainers have been, as you said, Hoka, On, Asics, and some of the smaller brands like Brooks and maybe a little bit of Saucony as well. Where they'll get share from is they'll recapture share in some channels. So the running specialty channel, they are completely at almost 0% market share. That's where they need to regain some share. The losers there will probably be Brooks and then to a lesser extent Hoka, because those are very heavily penetrated in that channel. And then I think it's all about consumer choice as well. Like if they put a more compelling product out there, the incremental sale may go to a Nike rather than Asics. I don't think they'll go back to 30% market share, but having lost 1,000 basis points, there's a nice room for at least several points of recapture in that segment.
Are Jordans still cool, Aneesha?
Not as cool as they used to be, unfortunately. They've leaned too hard into Jordans. Too many people bought Jordans over the COVID period, and so you're kind of up against the success of the franchise over the COVID years. But also because they overdistributed that franchise, it's not as cool and has as much scarcity value anymore. And that's what they're trying to recapture. They're trying to clear out some of the stale products within the Jordan franchise and try to recapture some of that heat and that scarcity value that makes Jordans cool again.
Aneesha Sherman of Bernstein, thank you so much for being with us. Man, humans, the way that people are, it's just so predictable.
I still think Jordans are cool.
Okay, so basically you're one of those people that thinks that if there's saturation, that doesn't mean automatically that they're not cool anymore.
I'm not a collector, but they're classic, right? Like, they're classic. You're never gonna get rid of the Jordan brand.
Unless there's like too many of them, you can go to a discount store, find them. They become uncool, Annmarie. It's about that short supply.
Okay, right. Well, all I can say is the resale market definitely does show that. Coming up next, not that. Joe Davis of Vanguard joining us, and Tony Rodriguez of Nuveen, as we do parse through the jobs data that we just got and looking ahead to jobless claims tomorrow, as well as what we see, of course, on Friday. Right now, about the same sell-off in S&P futures, down about 0.25%. Good morning. Some heated discussion around shoes right now. 1 hour away from the start of trading day, you can see essentially that weakness carrying through. Even though you did get better than expected ADP numbers, you do have that weakness continuing, led by the Russell 2000, still down about 0.8%. Right now, though, let's get some morning movers. Manus Cranny sitting there with them all. Manus, what you looking at?
Lisa, we're going to kick it off with oil. You've got the product itself up nearly 6% over the past 2 days. So this is carrying through into all of the big oils. Exxon, Chevron here up 1.74%. The debate is this: the calibration of the response from Israel to Iran. And Monday, we're with this morning, and they say, look, this is tit for tat. Until they go for the oil infrastructure or whatever, you're not going to see any further reverberation, and that's highly unlikely. But at the moment, big oil is bid up yesterday and rebid this morning. The Saudi oil minister, of course, putting $50 oil back on the mindset of the market. Roll it over and have a look at Alibaba. I put this ADR up here because we've got this FOMO gripping us around the world in regards to China. Are you in? Are you under allocated? Chinese stocks are trading at a 30% discount on a price to book value relative to their EM peers. And the conversations that you had on surveillance yesterday, which was about US fully valued pickup opportunities in China. Either way, mortgage rates are lower, and these big players on the ADR market are bid here in the US this morning. I'll leave you with a look at Humana. You look up the ratings for your holidays, for trains, for cars. Apparently, when you're over 65, you look up the rating on your healthcare plan, Medicare Advantage. The ratings drop on the Humana Medicare Advantage product. This is for the over 65s. The ratings drop, and so too do the numbers. 1.6 million customers. That is down by 94%. Ratings matter, not just in the airlines, Lisa, but on your healthcare package. Good morning.
Good morning, Menace. I like how you specify that. If you're over 65 and you're looking at ratings, well, I'll get there at some point. Meanwhile, ADP out just moments ago. Investors now looking ahead to jobless claims and September payrolls. Data from Vanguard showing that large U.S. employers are hiring at the slowest pace since June 2020. The team at Vanguard writing this: we expect this softening of the labor market to gradually dampen consumer confidence and real wage growth, resulting in below-trend GDP growth in the first half of 2025. Not necessarily calling for a bearish take. Still, nonetheless, joining us now to explain, Joe Davis, chief economist at Vanguard. Joe, thank you so much for being with us. I want to start just with weakening but not weak. How do you parse the difference at a time where we definitely are seeing weakening?
Well, sure. And again, I think that's also really at the heart of the Federal Reserve's response. So we've clearly seen a slowdown in the labor market. Part of that's been very welcome. I mean, we were out of balance for the past 2 years and had, really rapid wage growth. We're approaching the levels now where any further weakening or just slowing or cooling would really put, really bigger concerns on the table. I think the Federal Reserve has been weighing this information very importantly, and so, really explains, some of their pretty aggressive moves. I mean, I think the big tension in the market is, are the jobs figures really representative of the strength of the economy, or is it things such as GDP growth, which is going at 3% and not showing any signs of a slowdown?
So which is it, Joe? I mean, we just had Apollo CEO Marc Rowan speaking with our own Jonathan Ferro, and he was basically saying that the 50 basis point rate cut was a really expensive insurance policy, and that actually this is not an economy that needs it based on GDP and based on earnings. What makes you think that the labor market data, like the underpinnings of JOLTS that show that quits rates have really gone down, what makes you think that we should more heavily weight that?
Well, again, I mean, I think the whole insurance phrasing is actually pretty appropriate. Again, the economy is pretty resilient. I think we still have some turbulence ahead. Our lead indicators, which you mentioned at the outset, still point to some further weakness, and they're pretty powerful indicators given just the breadth of our sample. And so I think what they're trying to do, again, let's be clear, the Federal Reserve is all in on the soft landing expectation, and so I think they're going to be fairly aggressive to try to increase the odds that that happens. But there is risk in that strategy if the labor market, which I don't think it is, but if the labor market is sending the false signal and it's the GDP numbers that are more accurate or more representative, then 6 months from now we're going to have this crossroads, because the equity market, I think, is looking at GDP, and the bond market and the Treasury market is looking at jobs.
Well, Joe, Powell tried to solve this tension by just saying the labor market is a real-time indicator and GDP is not. GDP is historically bad at predicting a recession. Does that mean that we just can completely discount it, completely discount the strength and what it tells us about, one, inflation coming in and the likelihood that unemployment moves in a more malicious manner?
Yeah. I wouldn't be too quick to completely discount GDP, because underneath GDP is corporate earnings, corporate profits, business investment. And so I think it is important. I mean, again, I think, policymakers, to be fair to Chairman Powell, I think they are looking at a distillation, but there's no doubt that the Federal Reserve is weighing the jobs market much more heavily than the GDP numbers. Again, I think, the next several months we'll have some weakness. If we're right, then the Federal Reserve will look very prescient. But nevertheless, we're coming at a modest crossroads, I'd say roughly 6 months from now. And that is, and it's not a bearish crossroads, it's more of, is the equity market right, and this softness in the labor market is going to stabilize, and then we're following GDP? Or is it going to be the latter, and we're going to have GDP come from 3 to 2? I wish I had more conviction of which one it's going to be. Policymakers are trying to change that calculus in the next several months, but that is really the heart of the issue.
I love the way that you're phrasing this, because it's really accurate. It makes me feel like right now the labor market is going to dictate the bond market, and it's basically the GDP numbers. Atlanta Fed GDP is what almost every analyst who comes on the show who's bullish on equities points to and says, look, what slowdown? I just wonder how much the Fed could get ahead of this in economic terms. In other words, if they just cut by 50 basis points, if they do another 50 basis point cut, say, in November, how much could they affect change to actually bring the labor market up to GDP and GDI rather than bring GDP and GDI down to the weakness that we're seeing currently in the labor market?
Well, again, I think there are recent actions. There is some lag. So, I mean, the financial markets respond instantaneously. We're already trying to get ahead of the Federal Reserve. But in terms of the labor market, the next 3 months, they're pretty much baked. I actually wish I knew exactly what the numbers would be, but our leading indicators say, listen, there's still some choppiness, but they're not going to go negative. That would be a surprise to me. And so, again, I think where it's going to come out, the Federal Reserve is now trying to look 6 months out and saying, listen, we want to nail that landing. The only risk, I think, the more bullish part of the economists or analyst community is saying is, listen, you don't need to be cutting at all or not much. And so I think the Federal Reserve, if they're going to fight that narrative, they have to explain why they believe they're so restrictive and yet we have 3% GDP growth. I'm still waiting for the answer, but I think that's something that would be helpful for the Federal Reserve to articulate where they're going to go for the next 6 months.
Joe, but how are you going to review the non-farm payrolls report November 3rd that's looking back at October when you see all these mismatches in the economy and people will be out of work? We know that because of what's going on with the number of strikes in Boeing and the ports.
Well, again, I think you have to look at other things. I think you have to look at the new entrants coming in. I mean, one of the biggest reasons why we didn't have a more material slowdown this year was just the surge in immigration. So you're going to look at a distillation picture. It's not so much what the headline is. It's the breadth of job creation. It's industries that are always strong. Are they continuing to add at a current pace? It's the hours being worked outside of those strikes and areas. So again, like anything in life, there's going to be noise in that report. I think what you're trying to say more than anything is the diffusion or the breadth of industries and companies that are continuing to add to just the jobs.
Joe, you also talk about something in your research, a phrase that feels like it's been dropped by the wayside as of late, and that is the last mile of inflation. That's some of the unevenness that you see. You expect inflation to remain stubborn in the second half of 2024. Does that mean this whole sort of idea that Powell was doing some sort of victory lap, even though he didn't explicitly say it, saying that inflation has been conquered, that's not exactly right?
Well, again, I think the Federal Reserve, they're one of the few institutions that can actually affect the outcome because if everyone believes that inflation's on their control, it tends to go their way. But, the housing market and all of its esoteric calculations has been, one of the areas that's really been stubborn. And I think that, even Fed officials would acknowledge that. But again, this is a fairly dovish institution. But to give the Federal Reserve credit, they said that they could have a trade-off of bringing down inflation without a material impact in the labor market. Now, to counter, they got a really good luck in terms of the immigration surge, but tracking to date. So again, I'm not cheering against the soft landing. I'm just waiting to see, where does that calculus, given their aggressive cuts and what likely will continue for a little bit of time, where are we 6 months from now? And that's something that we will continue to focus on.
Joe, before we let you go, how much are you expecting the jobs report to surprise to the upside or the downside when we get them on Friday?
Oh, my goodness. I've been employed for 22 years, in part because I've tried to avoid these questions. But I would say there's modest risk on the downside, but take that with a grain of salt. If I was that accurate, I would probably already be retired.
I love it. I expected you to be like, whoa, suddenly disturbance, can't hear you. Joe Davis of Vanguard, thank you so much for being with us. We really appreciate it. In here, in the studio with us, joining us is Tony Rodriguez, head of fixed income strategy at Nuveen. And what do you make of that? What we just were hearing about from Joe, that essentially the bond market's taking its cues from the potential weakening of the labor market, whereas stocks really are looking much more at GDP and GDI.
I think that's accurate. And I think when you take that to the fixed income context, you're seeing the equity-like response in the credit markets, right? So emerging markets are doing well, preferreds are doing well, high yields doing well. So credit risk is highly valued right now, and the fundamentals are very solid. Defaults are low, corporate profits are good. So you're seeing the same story in the fixed income market. It's just that it's focused on the credit sectors. So I think the disconnect is maybe that in the treasury market, you are seeing people that are kind of hedging against their risk book. So if you have an aggressive equity position, one of the only things that's going to work well, if in fact we get the hard landing, that's not the highest probability, treasuries will rally, treasuries will serve as a hedge. So I think there's a lot of money in that market that is serving as a hedge to taking risk in the credit markets, taking risk in the equity markets, private markets.
That didn't work, though, over the past couple of years because the risk was inflation, and the different kinds of risk can mean that the bonds can be a buffer or not. Are you basically saying that increasingly bonds are a diversifier because inflation is off the table, that is no longer a concern in any investor's mind that you speak with?
Essentially, yes. I mean, we wouldn't say inflation risk is off the table completely, but it's certainly much lower risk than it had been. We do think inflation continues to come down. So when you think of fixed income, you want to get income out of it, liquidity, and a hedge and stability. Back when inflation really started to take off in 22, there was no income in it. There was no potential for protection because rates were so low. There was still liquidity. We sit here today and you have income now out of your fixed income portfolio. Treasury is probably the least attractive area to find it, but you do have income in it. And you do have now what we think will be a hedge because you're coming off of 3.5% to 4% type of levels rather than what had been sub 2% levels.
So, Tony, yesterday, we have a big risk-off type day. It's pretty textbook over geopolitical fears in Iran and Israel. It's pretty textbook except for credit markets. Spreads barely move, maybe 1 basis point for the overall market, maybe 5 for high yield. Is it a market immune to geopolitical risk, or is it just more calm investors? What is it?
Yeah, I don't think it's immune, but I do think it's more calm investors. Even oil prices, while they went up, they didn't spike as much as you might have expected. So I think people, maybe it's the frog in the boiling water type of syndrome, that all of these geopolitical risks, there are so many hotspots out there, and there has been escalating risk in all of them, that maybe the markets have seen the movie before, and it's going to be, a really cataclysmic event if, in fact, it gets to the point where we start to see really the Mideast theater expand into more players. But for now, I think the market's looking at it as this has just been the ebb and flow of this, continuing escalation that we're seeing. So we haven't had a major disruption, but it's a big risk out there in our minds, is that geopolitical risk.
Yeah, so if you were going to take that risk on board and you were actually really nervous that this was a different movie than the one we've seen, what should you be doing?
Well, from our perspective, there's a couple of things. One is that you don't want to be at the high end of your risk budget. When you look at not only the risks that are out there, but when you also look at just valuations in the broader capital markets, right? Fixed income, you look at credit spreads, equity market, you look at valuations. None of them are considered, historically cheap. They're at best case fair, maybe aggressively priced. So that tells you want to have some powder dry. You want to be kind of at the midpoint of your risk budget. In addition to that, within all the various asset classes, we're leaning more towards a little bit higher in quality, a little bit higher in liquidity, and making sure we have stronger fundamentals that can kind of see their way through any potential, impact from economic weakness coming from a geopolitical event.
There's sort of this counterintuitive feeling right now in markets. There's a real question. We were talking with Wei Li of BlackRock earlier this morning, who agrees with her colleague Larry Fink, who was talking about that maybe this bond market has priced in too many rate cuts. At the same time that people are talking about the potential for downside surprise that inevitably the Fed would respond to. Do you think that there has been sort of an overstating of the Fed's reaction function? In other words, a more bullish position on the economy? Or do you think that people are going to be surprised by how much they are going to have to cut?
No, I think that the markets are pricing in too many cuts. So there's been an overstatement of that. I do think that the probability of soft landing increased quite a bit when the Fed cut 50 as their initial cut rather than 25. And also when you saw what China has done over the last week and change, where again, they're not game-changing things out of China, but they are stabilization and first step moves by China. All of that helps to reduce the risk of hard landing. So to us, the Treasury market, the Fed funds futures market, aggressively pricing. Part of that, though, is because there are flows in those markets that are hedging. They're using that market to hedge. And we do think that if you get a hard landing, a very significant geopolitical escalation, the Fed's not going to stop cutting at 3.25 to 3.5, which is what our target is for the middle of next year. You'll see a sub 2% funds rate. You'll see a 10-year that's at 2% or lower. Again, that's a very low probability in our minds, but it will be an effective hedge to the declines you'll find in your equity market or the widening in spreads you might see in the credit market.
So if that's the low probability, does that mean base case, just the natural place for yields to go from here on out is higher?
I think base case is range bound. I mean, we kind of think fair value, 10-year, 3.75% to 4% is about fair value. It's a real rate that might end up in that 1.5% to 2% area. And we think that's a good long run equilibrium level. you rarely get to that level and sit at that level. But for now, that would be what we think is a fair value zone. So it's just the Fed that needs to get down in terms of the funds rate patiently in our minds, not 50 basis point cuts, but 25 basis point cuts. And if that happens, you can get this, sought after soft landing, which can help the U.S. economy grow. We don't think at 3%, but maybe sustain a 2%, 1.5% to 2% type of pace.
What's your call on the payrolls on Friday?
We'd say that the risks are probably to the downside, but not materially. So 100 to 150 we think is the right range.
Tony Rodriguez of Nuveen, thank you so much for being with us here on set. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. The death toll from Hurricane Helene has topped 150 across 6 states. The federal government reported 29 shelters are open with more than 1,000 occupants. Biden will visit the region today, making a helicopter trip over the flood-hit city of Asheville. He will also visit a rescue command center in the state before heading to South Carolina. Vice presidential candidates Tim Walz and J.D. Vance sparring over housing costs, immigration, and abortion rights in their first and likely the last debate ahead of next month's election. Both candidates largely avoiding significant gaffes while focusing on targeting the top of the other's ticket. A ring of fire eclipse is on the horizon. An annual solar eclipse will occur today when the moon obscures all but a sliver of the sun. This eclipse will take place mostly over the Pacific, with parts of Argentina, Chile, and Easter Island laying along the path. For those hoping to get a glimpse of the event, please wear glasses, solar eclipse glasses, because they block out ultraviolet light from the sun, and otherwise you could go blind. So really be careful. And this is my PSA, because this is what happened when we had a solar eclipse recently, and I saw people looking up with 2 sunglasses and thinking that might possibly help them, and it doesn't.
You're not supposed to look directly into the sun?
Okay, but it's actually, you are looking, you think it's surprising, like nobody looks at the sun, but it's obscured, so it's darker, and then everybody's looking up, and then they go blind.
It's dangerous.
Yeah.
Well, it's your natural inclination. You're like, something cool is happening in the sky, let me just look upwards, and you shouldn't do that.
Yeah, I just looked at the light, and now I'm seeing stars. Up next, setting up for the day ahead, this is Bloomberg. We are counting you down to the opening bell. Here is what's coming up as we do see another day of losses. More Fed speak coming up at 10 a.m. from Musalem ahead of Barkin at 12:15 p.m. 50 or 25, maybe they'll tell us. Tomorrow, we'll get another round of jobless claims they're not going to tell us. Plus, factory orders, durable goods, and ISM services. And Friday, it is the main event, September payrolls. Will you get 150? Will you get 140? Are you not going to predict like Joe Davis because he is not going to try to lock anything down? Maybe going to predict is Bloomberg's Michael McKee, who is back with us. Mike, what's your number?
I would put it in the 150 range, but only because I don't have a better guess than the consensus and the wisdom of crowds at this point. And like I've said several times, it may not matter, because the real number that matters is the one we get before the next Fed meeting.
And that's going to be a complicated number because of strikes, because of hurricane impacts. How should we actually be looking at the figures from here on out with that knowledge? Is it going to be a choose your own adventure because you can maybe assign any narrative to it?
It could be. I mean, we'll see what the other numbers we get between now and then are, but the Fed has said they're watching the payrolls numbers. And so if we get a really bad number, then people may just say, it was a really bad number. And the key thing is most people are, and the Fed has emphasized, look at the unemployment rate. The unemployment rate is not affected by the strikes. So that probably won't go jumping. It might rise just for other reasons. But it's going to be hard to say how people and how the Fed, how voters, how everybody will react to something 4 days before the election.
Mike, can we talk about the other side of the Fed's mandate, inflation? Do you think they're concerned about what we're seeing right now out of the Middle East and the spike in oil prices?
I don't think so yet. Obviously, inflation is always a danger from energy, but energy prices have come down a lot, and they would have to go up a lot in a short period of time to have an impact on the CPI next month, because we're already below where we were. Oil prices have been going down for 6 months. So it's not a real danger at this point. And gasoline prices have reacted very slowly to oil prices, but they have been coming down at a retail basis very regularly. So it's not even clear that Americans would see a change at the pump that would cause their moods, either their confidence to spend or their desire to vote for somebody by the time the election comes around.
So maybe that's not an inflationary risk to the Fed right now, but we have heard Fed speakers Austin Goolsbee talking about the port strikes and the potential risk there. At what point does it stretch on long enough that it becomes a macro issue for the American economy and the Fed needs to pay attention and recalibrate?
Well, it's hard to say exactly, but after a couple of weeks, you'll see some segments of the economy start to see shortages, which will drive up prices. We've joked about how bananas are going to get hit right away because 75% come in through the ports. But it depends on how much it affects people's jobs and inflation. And inflation is probably going to be sticky in this case, slow to rise, because companies are going to be looking through this as well. And they don't want to make people angry, customers angry. The question is, are we going to see companies relying on inputs have to close down production because they can't get the materials to keep making this stuff that they're making?
Bananas aren't a joke, Mike, just to be very clear, because they will rot, and that is the main source.
We have bananas upstairs. You can go grab a handful for the rest of the week.
This is the problem, when they rot, and you don't want them rotting at your desk. That's a problem.
Them.
I mean, okay, well, we can discuss the freezing. Michael McKee, thank you so much. And keep in mind, bananas are important. Coming up tomorrow, Jared Woodard of Bank of America, Adam Posen of the Peterson Institute, who will tell us all about the other side of the risk, the inflation side of the risk, and Lindsay Piegza of Stifel. Jack Manley of JP Morgan also going to be joining us. Today, we're parsing through a number of different risks, a number of different possibilities. It seems like up front, people are wondering about the jobs data that we got yesterday in terms of jolts and the underpinning of quits and how much that's going to affect things. You've got the geopolitics of it. And then you have just sort of this uncertainty, this overhang of what is going to happen with the election and just how much could policy potentially shift. Danny, what do you have your mind on right now, other than the seagulls at the ports and potentially what that could mean if that does carry on?
That is certainly still on my mind, but I just come back to what we keep experiencing over the past 2 months, that every month starts with not this specific risk that we're dealing with now, but some sort of risk, and the ability of the market to look through it, that it can say, look, the Fed is cutting, China's issuing the stimulus, why not buy? And maybe why not buy not just the U.S., but China, EM, all the risk assets look so attractive right now. And the market has been remarkable at just looking through the headwinds.
It's got to be the geopolitics. We're waiting for Israel to respond. Will that be today? Will that be in a few weeks? And as you said, so many clouds overhanging this election.
Although a lot of people don't seem to be trading on them, as we heard earlier in this hour. Right now in markets, though, you do see a soggier feel, even with better than expected ADP report, although coming back a bit. S&P futures now down just about 0.1%. A little bit of dollar strength across the board, and you are seeing yields actually markedly higher, particularly on the long end, up 7 basis points. This was Bloomberg Surveillance.